All right, let's go ahead and get it rolling. Everything looking good on my end. Let's go ahead and start the stream. Let me know in the chat if everything is coming through loud and clear, please. Welcome back to the channel, Crypto Trend Trader, with our first Friday morning live stream. Going to be making this a weekly thing now. So you'll be able to catch us on Friday Eastern Standard Time at 11 a.m. and then Sunday and Wednesday 8 p.m. Eastern Standard Time as well. And before we get started, I'd like to remind you this is not financial advice. I'm not your financial advisor. These markets are extremely volatile, so please do your own research and trade responsibly. So today we're going to be taking a look at a bunch of various charts here, doing a little bit of the technical analysis. Might talk about a couple of fundamental macro factors as well, as far as economics and global, well, you know what I'm talking about. But we'll take a look at the TNX chart, take a look at yields and what's going on over there, DXY, the relationship of the dollar to a basket of currencies. And then, of course, we're going to take a look at some of our commodities, gold, silver. We'll look at the junior miners for gold and silver. And then we're going to take a look at uranium, some pot stocks, and then lumber. And then, of course, we will take a look at some cryptocurrencies. I have a couple of requests. If there is a particular crypto you would like looked at, please leave it down in the chat and make a little time for those as well. And then, of course, we're going to go through our stock market main indexes and then U.S. oil as well. And then we're going to talk about a couple tech stocks. So quite a bit on the itinerary for today, but we should be able to knock through all of those. Just a reminder also, we do have Monday off this week for the stock market. So the markets will not be open on Monday. We have a 3-day weekend coming up. So when we close tonight for our stocks and futures markets, we do have futures expirations today as well. So when we do see those close out, we're gonna have an extra weekend for crypto to, well, do its shenanigans. So typically I would say maybe pump, but who knows what's gonna happen these days. So what's up, Asotos? Good to see you, my friend. Loud and clear. Thank you, my friend. Tim Winkler says, hey, Crypto Trend Trader, thanks a lot for the Friday stream. For sure, brother. It's the new weekly Friday stream. So hopefully the difference in time also. I know we do have quite a few international, fans, subscribers, watchers, group members, etc. So trying to diversify the timing a little bit. And I think kind of going into our early Friday, going into the end of the week and then preparing for the crypto moves over the weekend. Kind of sets us up. So we have basically that Sunday, get ready for the week in traditional markets. We have that Friday, get ready for the close and weekends and what we can kind of expect going into our Monday. And then, of course, Wednesday for our midweek market update. So we can just kind of, keep an eye and touch base on what's going on with the market. So, and then obviously we have the group, if you'd like access 24/7 all the time. I wish it was less than that, but to tell you the truth, I'm pretty much always active in these markets. So you can reach out to me via email for that. Always accepting new group members. And the group members and their contributions are what makes it possible for me to dedicate additional time. And as a benefit to the group members, do release the 2 main indicators I'll be using in this stream, the TJD Jewel Thief, and then also the TJD Master. And then even if you don't want to make a contribution, whatever, you just want to hang out, you just want to learn some stuff, use some of the free resources down below in the description of the video. You will find 15 or so indicators that thousands and thousands of people are using for absolutely free. So you can just check those out on TradingView as well. Some of them are older versions of the same indicators. Some of them are completely different indicators, but they're all absolutely free with the exception of the 2 that are exclusive to group members. But that being said, we've got a couple people showing up in the chat over here. So let's go ahead and get this thing started. UniQ, finally able to catch a live stream. Yeah, man, and that's the goal too. Yeah, that is exactly the goal, to be able to do it at a different time and allow access to some of the international viewers or just people that have other stuff going on. Maybe your kids are home, so you can't mess around. Because obviously I don't necessarily keep it PG. Although maybe on the daytime streams, I'll try to, tone down the, tone down the, I call it comedy. Other people might call it, lewd language or inappropriate analogies. But, I like to have fun with it. So Craig's man says, thanks for doing the Friday stream. For sure, brother. For sure, man. Thank all the people that have shown their support because, that's what makes all this possible. But that being said, we have had quite a bit of volatility. So let's go ahead and jump into these markets, guys. Lots of excitement going on here. So we have seen a lot of the trends that we have been discussing, that we have been preparing for over the last couple months are really coming to fruition. So the big discussion we've been having was the talks of metals potentially breaking out and miners shining in 2022. And then obviously we've been calling out the bearish divergence on the weekly chart in, and monthlies as well in Bitcoin and, cryptocurrencies as well as traditional markets. And we are starting to see a lot of that show up. So let's take a look and get some targets out here and look at the overall trend and see what's going on. So just starting off with TNX, I like to look at the TNX chart, look at the 10-year treasury yields and get an idea as to what we can expect. And then that gives us a better idea as to what's happening in the markets. And you guys know that the main reason I like to look at the yield is because that's what I consider to be the cost of money. So if you're going to borrow money from someone to fund whatever it is you want to fund, whether it's an investment, whether it's, building a house, buying stocks, growing your company, whatever, you need to borrow money to do that. So the cost of money is a direct relation to the amount of things that people are going to invest in or create or growth. So cost of money is very important. Same way we look at oil as the cost of transportation. You need oil or fuel or whatever you want to call it to basically create things, to transport people around, to actually produce stuff. So if you need money to, grow, you need oil to move things around and build, create, manufacture things. Those are two huge factors in the market right now. So, everybody else can focus on inflation, deflation, this, that, and the other, but we got to look at the root causes of these things. And that can give us a much better idea as to what we can expect into the future, for commodity prices, for inflation, for investments, for stock prices, for valuations, for all these different things. So it's so much more important to start with the big picture and then work our way down. All right, we already got our bot. So we're going to have a whole new set of bots, obviously, for daytime. So bear with me, guys. Just let me know if you see one pop up over there. You guys know I always block the bots. All right, sweet. So let's get rolling with the TNX. So let's just zoom out here. Obviously, the TNX is very bullish. On the daily chart, we're up here in the bullish control zone. We have a bunch of green histograms. We have a blue slope line. The 8 and 21 are bullish to the upside. The 200 exponential has crossed above the 200 simple. Everything on this chart right now is bullish. Now, we are starting to see the jewel thief rolling over a little bit here. So as we kind of see this rolling over, we know that we're seeing at least a little bit of short-term weakness after a powerful run to the upside. Does not in any way threaten the overall trend, but it would not be unrealistic to think we consolidate for a bit. Now, switching over to the weekly chart, this is where things start to get interesting. So we basically had sold off below the 200 exponential and 200 simple back here in June of 2019. Those flipped over bearish. We see them flipping red from blue right here, and then we essentially entered into a bear trend on the weekly chart, at which point in time we had a massive drop essentially down to almost 0.382 on the 10-year. So we were at, essentially when we made this cross, when we confirmed into a bear market, we were at 2.3% on the 10-year treasury yield, and then we went to basically 0.4%. So we lost about 2% or 8 basis points, 8 quarter rate hikes on this. So now here we are now back at 1.92. So we're basically back at 2. But the most important thing we see here is obviously we were able to pick out the bottom based on some bullish divergence, based on the fact that we basically hit 0. So you can't go any lower, bro. And then obviously we flipped over the blue trend. We're above the 0. We start moving back to the upside. We crossed the 821 back to the upside. All these bullish things start happening. We put all the pieces together. And then, of course, we run into the 200 exponential, find resistance as expected. We put in a higher low. So clearly we have an uptrend. We bang our head on the 200 exponential again. We put in a third higher low, and then bam, we bust through. And now here we have broken through not only the 200 exponential and flipped the slope over blue. So that's a first big sign to the uptrend reversing, or the downtrend reversing, I should say, into an uptrend. But now the 200 simple has almost a flat slope. So we still see it's still angled to the downside slightly here, but we're also well above it. So what we would expect to happen is this to get a little bit tired here, kind of cool off some, and then come back down and retest the 200 simple as support now, right around that 1.7675 level. So not unrealistic to think that we have a pullback in the 10-year Treasury yield, kind of retest, consolidate here for a bit before going higher. Now, if we look at the Jewel Thief, we are very much in the bullish control zone and powerfully angled to the upside. So that is definite strength. Bulls are very much in control. And then if we look at the TJD TDMACD, we see obviously a bunch of green histograms. We are back above the slope line. The slope line is still red, but again, it is essentially flat right here. So it's very close to just flipping back to the upside. And we know that when this slope goes from 0 to positive again, it will turn back blue. And that shows us strength and continuation to the upside. So again, on the weekly, starting to really reverse strong, powerful downtrends that last for a long time. So very clear that, we're going to be approaching to the upside. And now if we really zoom out and we really look at the big picture, this is our monthly chart, and we can go back to our peak back here in the 1980s. Everybody knows what happened in the 80s. The 80s were the last time we had rampant inflation. This was massive, massive amounts of inflation. We actually had the Fed funds rate get up as high as like 20+%. The 10-year Treasury yield got up here at around like 16%. I mean, unheard of numbers. Can you imagine going out and taking out a mortgage and paying 15% on your mortgage? Granted, it would probably be like a 10-year mortgage or something like that, but 15% sounds absolutely ridiculous right now. I mean, people are complaining now that it went from 3.5% to 4.5%. So think what that does to like home values. Now, I'm not saying that we get back up to those levels, but what I'm saying is we've been in a very clear downtrend for the past 40 years. So for 40 years, bonds have been in a bull market and yields or rates have been in a bear market. So money has been getting cheaper and cheaper. So if we're potentially seeing, a series of highs and then lows and then lower highs and then lower lows just this whole time for 40 years, and we're potentially talking about reversing that trend, what is that going to do to valuation? What does that do to the price of things? Whether it's stocks, whether it's houses, whether it's, various different investments, cryptos, bonds, whatever it is. If the yields start to go up, the cost of money goes up, those valuations all come down. And we've been talking about this towards the end of 2021 and then into 2022. And that's why our trend this year is multiple compression. So when we see historically, when things were like stocks were evaluated, people look at the price or the value of that company and they look at it as essentially, okay, what are the earnings of that company? And then what's the price of the stock? And then that ratio, the PE ratio traditionally tells you, is this company expensive or is it cheap? And we can look at historic levels like 10 or 20 or, whatever and say, okay, this is extremely high levels in comparison to history. It's extremely low levels in comparison to history. And we get an idea as to how these companies are being valued. So multiple compression tells us that as money becomes more expensive, that we would expect those multiples to compress. So we would expect good companies that are valued at 20-to-1 PE ratios, we would expect those to come down to maybe 15 or 12 or 10. Because money's getting more expensive, therefore, people have to value those companies less because they're going to make less money on investments in those companies because money costs more. So that tells us that multiple compression in these companies will cause valuations to come down the same way you would expect it to happen in the housing market or something like that. Now, on top of that, we have something that's never been done in the past that has been taking place over the last, 10, 20 years, etc., which is essentially instead of using price to earnings ratio, we've been using price to sales ratio. And why do we use price to sales ratio? Well, typically in the past, people would only invest in a company that makes profits. You're not going to invest in someone's shitty company that doesn't make any money because they're like, oh, it's a great company. And you're like, oh, really? How much money you're making? And they're like, oh, no, we're bleeding $1 billion per year. Oh, awesome. But not just for now. Soon we'll make money, though. I promise. Oh, okay, great. I'll invest in your company even though you're losing $1 billion per year. How long do you think it's going to take? Well, 10 years and then we'll be making money. Oh, okay. So if you just lose like 10 or maybe 15 more $1 billion, then you'll be profitable. Okay, yeah, that sounds great. I'll invest in your company. Think about how stupid that sounds, how idiotic that sounds. That is the market that we're in and have been in now for years, decades even. So we have price to sales ratios and, Amazon is one of those companies where they essentially had a great business plan and everybody uses them as an example for like, this is the next Amazon, this is the big one. Everybody said this about Amazon back in the day, and now look at it. Don't you wish you would have bought Amazon at $75 and Amazon went down 75%, and now look at it. All you had to do is just buy and hold, bro. Sure, Amazon is literally, it's not even a unicorn. It's like the unicorn of unicorns. It's the one thing that ever in history has done what Amazon did. So to try to compare all these other companies and say, you don't have to make profits for 10 or 15 or 20 years, as long as eventually you're just going to dominate the market and put everybody else out of business. That worked for one company like ever, or, you know, a handful of companies. So when we look at these price to sales ratios and we see ridiculous numbers for these companies that don't even make money, those to me are the companies where, again, we've been saying this multiple compression will hit the hardest, because the multiple is not even based on actual earnings or profits or a profitable company. It's based on their sales. So you're saying, okay, if we just continue to grow sales, even though we're losing money on those sales, eventually we'll start making money on those sales, and then we'll become a profitable company, and then we'll be the next Amazon. Well, think about how many things have to go right for that situation to play out, and then think about how many people are betting on that. So the majority of those companies, in my opinion, will blow up. Now, granted, this is not financial advice. I'm not your financial advisor. These markets are extremely volatile. Please do your own research. Trade responsibly. Markets are extremely volatile right now, and we're potentially talking about reversing 40-year trends. So we need to really keep an eye on what's going on here and invest intelligently. And one thing I've been saying to the group members repeatedly is my strategy for 2022 is, if it don't make money, it don't make sense. Okay, and what do I mean by that? Like, if it's not a profitable company, if it is not making money, if it is not growing and expanding and profitable, I don't have any interest in being invested in it. Now, that's different for, you know, a swing trade or a scalp or something that I'm seeing on the technicals, whatever. But fundamentally, I don't want to invest in things that are not making profits, because I can't accurately value those. And we're seeing dynamics in the market shift where other people also cannot accurately evaluate those. And price to sales ratios is not an accurate evaluation, because essentially, you know, I consider myself to be a value investor. I look at technicals to trade, you know, whether it's scalping, whether it's swing trading, and even investing over long periods of time. But when I look at investing, I look at fundamentals. I want to see, is this company going to be growing over time? Are they going to grow their users? Are they going to grow their profits? Are they going to grow their business? You know, what do I see that tells me this is going to be a good investment for a long period of time? And so what I look for is things that are undervalued a lot of the times, which is where I see, like, you know, gold miners or pot stocks or some of these other things where they're trading at like a discount to book value, or they're trading at valuations, you know, in gold miners that, you know, take into account like a gold value of 800 and now we're at 1800. Like, I look for things like that. So you can't do that with a company that is literally losing money in the same way. So a lot of these like tech companies or whatever are like, oh yeah, so yeah, we're losing money, but our sales this year or our income this year was, you know, $100 billion. Okay, great, $100 billion, that's awesome. But we did lose $10 billion. Well, if you took in $100 billion, how'd you lose $10 billion? Well, we paid everybody, you know, $1.25 to join into our company, and, you know, they spent $1 with us. So you're paying people to acquire these customers essentially, and losing money doing so. And like a lot of companies have a business model like that. So if we're trying to buy companies for 50 cents on the dollar, a lot of these companies with these crazy valuations are buying customers at like $1.50 on the dollar. They're like, we're going to make $1 off this customer over their lifetime. Well, that's great. Awesome. How much is it going to cost for you to acquire that customer? Well, it's going to cost us $1.50. So you're going to lose 50 cents per customer. So the more you grow, the more you lose. That is not a legitimate, sustainable business. So they're counting on something changing into the future. And that is why right now, if it don't make dollars, it don't make sense for me. Now you can do whatever you want, but that's my justification. So now that being said, let's go from there and let's look at how we're looking at potential reverse in the market. And all of a sudden what worked for so long might not work into the future, at least for the next couple of years or maybe decades, or who even knows, maybe it will never work again. We don't know that. We don't need to know that. What we do need to know is that things look different. So now here on the monthly 10-year treasury chart, we see 40-year downtrend. And now we're doing the same thing we've done over and over again. We sell off pretty violently. We revert to the mean. The mean being the average of the previous 200 months. And then we have the simple moving average, and then we have the weighted moving average, which is exponential moving average, which takes you into account a heavier weighting or a stronger weighting towards more recent data. Okay, so we use the two of these because it gives us a better picture as to what different people might be using. Most traditional investors use the simple moving average. Most, crypto or more volatile, like investors or markets, use the exponential moving average. We see here over time on a monthly, though, they're basically in the same spot. So it's less relevant here. But regardless, what we see is we'll sell down aggressively, we'll revert to the mean. And then we get rejected again, we sell down aggressively, we revert to the mean. We get rejected again, we sell down aggressively, revert to the mean. And we see this happening over and over again, every few years, but continuing the downtrend. So the more likely thing to happen is we're clearly in a downtrend, putting in lower highs and lower lows. Most likely thing to happen is we revert to the mean. Now, obviously, we've been saying that since down here, but now here we are almost there. So do we have to come up and touch the 200 exponential and simple moving average at 2.7 on the monthly? No, we do not have to come up and touch, but it looks very likely at this point in time. Why do I say that? Well, if we look at what's going on here, the 8 and 21 have crossed back to the upside. We're in the middle of an aggressive move back to the upside based on our moving averages. So our next clear definable target based on moving averages is that 2.6 level. And then if we come down here and we look at our indicator oscillators, we see that once we leave the bearish control zone, once we get that hard buy signal, we start trending to the upside. That's obviously our bullish signals taking place. And then we often will tap our head on the bullish control zone up here at 80, get a temporary rejection, and then come back up and continue into the bullish control zone. We see it happen right here. We come up, we tap our head, we get rejected, we come back up, we go higher. And we'll see it happen many times throughout history, where we'll have a small rejection and then actually go higher afterwards. So that's what we're expecting to happen based on what's happened in the past. So that's with, the jewel thief down here on the stochastics. Now let's look at this trend here as well on the TJD TDMACD. We see what happens is we have an aggressive sell-off, we come all the way back up, and then three things have to happen for this to be bullish again. We have to have 2 or more green histograms in a row. We have to cross above the red slope line. We have to cross above the 0 line, and then eventually the slope flips back from red to blue. So every time we see that happen, now you have a couple times where it kind of chops around a little bit, but essentially we're putting in higher lows throughout that time, and that's basically all just one big kind of trend to the upside here. Or you could look at them as individual trends, whatever you want to do, that's fine. But we see typically what happens is we'll have a nice long trend to the upside, then one to the downside, then one to the upside, one to the downside, upside, downside, a little chop in between sometimes. But now here we very clearly have had one to the downside, then one to the upside with a little bit of chop in between, and then we had one to the downside, and now we're flipping back over to the upside. Now, is it possible this gets rejected and rolls over? It 100% is possible. But we have momentum now in our favor, everything in our favor on the monthly, leading us back up here. So the most likely thing to do is, well, we've been in a 40-year downtrend, so most likely we're going to push up here to a lower high once again and get rejected. So more than likely, we're not going to make it above 3.1. More than likely, based on everything that's ever happened for the last 40 years. But more than likely also, we're probably going to get rejected on a 200 because we see that happening over and over again. So if that puts us at, roughly 2.6, 2.7, that tells us we still have a little ways to go because we're at less than 2% right now. So the percentage move and the velocity or the intensity of that move, it's another 33% to the upside. So if we see the yields go up by another 33%, and this is inversely related to the price of the bonds, does that mean the treasury bond is going to go down by 33%? The price of the bond, the principal that is invested in these bonds? Well, for the most part, essentially, the relationship is the same. The percent doesn't have to be exactly the same, but that's what we're paying attention to, is that inverse relationship between the two. So if we know that more than likely what's about to happen is from where we're at right now, that the price of money is going to go up by 33%, we know that we're going to see some sort of inverse relationship between the value of the things that you would spend that money on. So whatever you would take a loan out on, a house, cryptocurrency, growing your business, investing in the stock market, whatever it is, the price of money is going up. So we would expect those valuations to go down. Now, that does not mean that we're going to see everything go down in price. It does not mean a can of chicken noodle soup is going to go down in price. It does not mean that a loaf of bread is going to go down in price. I'm talking about money that you borrow to invest in things. And that's a big, big difference. People think, oh, okay, well, inflation's going to stop or it's going to stagnate or we're going to see deflation or whatever. I'm talking about the prices and the values of investments, commodities, etc. I'm not talking about your daily prices. We almost never, historically speaking, see daily prices for, goods and services that we consume go down. They sometimes trend slowly down with like efficiency and technology and things like that. But there's too many macro headwinds now that tell me that prices will never be going back down to those levels again, at least not anytime soon. We know for a fact we've been in a, 50 to 100-year period of globalization where essentially everybody has been outsourcing things that are expensive to do to somewhere else where it's cheaper to do them. America is number one most guilty of doing this. We literally have every other country or certain other countries produce everything for us, and then we sell services, but we import all of our goods. Now, part of that is because we're the world reserve currency, but part of that is just because of efficiency. If we can pay some other person in some other country pennies on the dollar to do the same thing that we could pay someone here in the United States to do, we're outsourcing that because it's capitalism and we want to make more money, so we do that. So that is globalization. Everybody's working together to make the world more efficient. Well, we know for a fact that after everything that's happened, that the supply chains have broken down and this just isn't working the same way it used to. And we need to reevaluate the fragility of what we've been doing. And we need to bring certain manufacturing back home. And now that's for every country, not just the United States. Every country says, whoa, this semiconductor thing is a real deal. Maybe we should think about manufacturing some of our own semiconductors. Maybe we should get ourselves a foundry on our own soil and do some of this stuff. Maybe we should start, making our own food. Whatever it is, whatever these essentials are, whether it's weapons, whether it's food, whether it's, semiconductors, whatever it is, countries are reevaluating this. So that tells me that globalization as a whole is going to start trending down, and nationalization as a whole is going to start trending up, where people start doing things back home, made in America, made in whatever, like, American pride or whatever you want to call it. The nationalization trend is starting to pick back up, and the globalization trend is going down, especially as we see tensions mounting in various countries. Say you get your oil from Russia and it's like, oh, there's some crazy stuff going on in Russia, maybe we shouldn't get all our energy from them. Or you get all your stuff from China and it's like, oh, there's some crazy stuff going on with China, maybe we shouldn't fully participate in slaves making goods for us so we can save a couple dollars. Or whatever it is. I'm not saying that those things are happening. I'm not saying that China and Russia are evil or the people are bad, but I'm saying that if they were doing shady practices and, maybe we didn't want to participate in those practices, it might be a good idea for us to become more independent again. Not just us, America, but, the world in general. So those are the global macro trends as we see them. And then every time we evaluate a stock, an investment, a house, a loan, anything, we should be taking into account all those things and how they're going to affect the choices that we're making. So now that we have that laid out groundwork that we've discussed countless times and what we're potentially expecting into the future, how does that affect these markets? How does that affect valuations? How does that affect multiple compression? Inflation of costs of, goods and services, commodities, stock prices, houses, cryptocurrencies, whatever. So now that we have a basis there, we can look at things with a little more of a broad brush, and then we can see, okay, this is the macro trend and what we're potentially expecting. What's the micro trend? What's going to happen in the short to midterm? What kind of trend are we looking at? Like when we're looking at uranium, we're talking about a 20 to 30 year market. We're looking at commodities in general, we're talking about 3 years, 10 years, 20 years. When we're looking at something like, a quick little stock or, a quick little scalp, like a reversion to the mean play on something that's going into a bear market, we're talking about a couple of days, maybe a couple of weeks, and just trying to grab up a quick percent. So we need to keep all these things specifically in mind and make sure that we're understanding and keeping the big picture, but also focusing on the relevant small picture as well. So Peter, good to see you, my man. Great time for a stream. Yeah, glad to have you, man. Every Friday from now on. Andreas is in the house, says, yeah, great time. Let's go. Yeah, definitely, man. I appreciate all you guys, especially my international, crew. So definitely going to be a better time for a lot of you guys. And then obviously, going into the weekend, we can kind of prepare, closing out trades, whatever it is, preparing for crypto volatility, etc. So let's look at U.S. oil now. So now that we have the broad picture, so we know that the treasury yields or, the Fed funds rate is the cost of money. Now we're going to look at oil as the cost of, creation or transportation or, the cost of doing business. So we know that oil, produces things or makes the, energy that transports things or whatever. So we know that oil is relevant the same way that the fund percent is relevant to how much money costs. The price of oil is relevant to the cost of all goods and services, basically, in all economies throughout the world. So we know on oil here, we basically have this ascending broadening wedge. So we have higher lows consistently, we have higher highs consistently, and the range between those higher lows and higher highs is consistently getting bigger and bigger. So we have a wider range that we're able to play inside of. So we have a tight range back here. It's just a couple dollars, and then it gets slightly bigger and then slightly bigger. And now here we are, and we have a real big range that we get to play inside of. So each time we have previously touched this resistance line in red was one of our tops. Each time we touch the support line in green was one of our bottoms. So more likely than not, we will continue to trade inside of this range. Does it mean we have to come all the way back down to the bottom? No, it does not. Does it mean that we can't break out of the top? No, it does not. But we know that it's been consistently happening. So the way we like to play trends, the way we like to play patterns or, channels or whatever we're looking at is they only really break out one time. Sometimes you have a false breakout. Sometimes you have a failed breakout. Sometimes you have, a stop hunt that looks like a breakout and then it doesn't. But the real breakout only ever happens one time. So we can play this same pattern over and over again until that one breakout happens. And then we say, okay, the breakout happened. Now we reevaluate and we look for the measured move of the actual breakout. So here we see more than likely, based on what's been happening, we will get rejected right here and we'll come back down and retest some of these support levels. So what we need to look at is, what are the support levels? Well, we have a very clear top right here, which is a previous support level. So that would be stair step number 1 at about $83 for oil. And this is the US oil WTI crude chart. So our next target to the downside would be the 200 exponential and simple moving averages, which will continue to trend up regardless of whether we go up or down. So, where do those intersect? Well, time has to do with those because they're constantly moving. So if we just all of a sudden right now capitulated down, it would be at 76. If, it took a while, maybe we're all the way up here at 83 at that same support line. But that's worth paying attention to. And then, of course, we have other various levels of support, based on like historical things like Fibonacci targets, etc. The bottom of the channel down here, which again will continue to keep going up, or the bottom of the ascending broadening wedge, which will keep going up as we go. This is not actually, a support line. This is just a drawing tool that I put on here for the actual trend. So essentially, that's what we're paying attention to, is somewhere, down in this range for a retrace. Now, the stronger this is and the more likely it is to break out, the less it comes back down. Each time previously, it came all the way down to the bottom of the channel. Here we see it came down to like the halfway point and then put in a lower high and then went all the way down. Here we see it came down, put in a lower high, and then, had a couple steps down on the way. We would expect the same thing to happen here. It comes down here, tries to push back up, puts in a lower high, and then eventually comes back down. Perhaps it puts in a higher high and breaks out to the upside. We have to wait and see. But we know here we're getting the sell-buy-sell signal, the sell-buy-sell signal, the sell-buy-sell signal. Every time we have seen that sell-buy-sell signal and left the bullish control zone, we have sold off. So that is the most likely situation. Doesn't mean we can't temporarily put in a higher high and squeeze some people out, that short this at the wrong time. But more than likely, we lose momentum, we get the red slope down, we break down. We lose momentum, the blue flips to red, we break down. We lose momentum, blue flips to red, we break down. So here we still technically have momentum for now, but once the histogram continues to go down here, once it does it for long enough, the blue will level back out, it will flip red, and then we'll come back down to the bottom of the range. So we know that this looks like it's losing momentum. We'll see the 821 cross to the downside if that takes place. Eventually price gets down below 89 long enough, the 8 and 21 will cross down, and then we can start looking at these targets. But right now, it looks like oil on the shorter time frame wants to put in a pullback. Now let's switch out to the longer time frame and see what oil's doing. Because a lot of times people get caught up and they're like, oh, he's bearish oil now. You were bullish oil before. Why are you bearish oil now? Well, I'm super bullish on oil. I was the most bullish on oil when everybody else was talking about green energy and sustainable wind and the water and the future where everything's gravy and we don't need oil. Yeah, okay. How about we use our brains? How long have we been using oil for? And show me one country that is functionally using green energy, without having atrocious problems. Yeah, okay. So I'm macro bullish as hell on oil and nuclear energy, and possibly, nuclear fission. I don't know if anybody has been following that, but we just had a nuclear fission breakthrough from one of our countries in Europe. So pretty cool. Definitely some potential there. But how long is that going to take, before we have nuclear fission, like full on functioning? I mean, 10, 20, who knows how many years. But that's definitely cool. But it's not just going to change overnight. We're not just going to start putting in, a bunch of reactors all over. We're not going to have cell phones powered by tiny little like nuclear fission reactors. Wait, fusion? Fission? Yeah, okay. I might have said the wrong one there, but you guys know what I'm talking about. So anyway, all right, so we sell off here from our macro high on oil at 144 back in 2008. We then proceed to put in a low, then a lower high, then a lower low, then a lower high, then a lower low. So we're clearly in a downtrend from 2008 until 2020. So a 12-year downtrend from an all-time high on oil. At which point in time, I start calling for the bottom. We start talking about momentum and oil building back up here. It basically goes negative on futures charts, etc. But we know that oil was super cheap, way cheaper than it should have been, because there's no infrastructure in place to change the way that society or the world or production or transportation functions as a whole. So we know that a bunch of people are getting behind a trend that is not ready yet. So remember what I always say. You can be early and you can be right. But if you're early, you're still wrong. It's the same way you can be late. You can be right, but if you're late, you're still wrong. So it's not about just picking out some macro trend if it's going to take 50 years and you lose all your money before the trend happens. So here we see, once we basically put in a potential Adam and Eve type bottom, we take out that descending trend line right here and we start to break out to the upside. That's when we can start looking for essentially like a massive breakout to the upside. Essentially, I mean, conservatively or aggressively, we can just say from the bottom of our Eve rounding bottom to essentially like the neckline right here, just a measure move break from where we're at right now would take us up essentially to retest the all-time highs or possibly new all-time highs. Now here as well, let me turn off the moving averages to just kind of clean this up for a minute. So here we have our high right here, then we have our low is that wick down here, basically at zero, or you could put it at, you kind of have to be a little bit subjective on where you put the zero down here. I put it down at like $10 a barrel. You could put it at zero. You could put it at negative whatever. It's hard to fib something like that, to tell you the truth. But I like the way the fib lines up in this case based on where we put it at. So that's why I have it right here. So it's not clockwork, but essentially we can look at it and see, okay, there's some clear levels that were important along the way. This would be the top, obviously, then the 886, then we see some support at like the 786, and then we see like various support levels along the way or resistance at like the 618. So I have it where I think it fits best. Normally it's not nearly as subjective as this, but with super volatile things or things that go negative or weird situations, sometimes you have to use a little bit of discretion. So here we have basically the breakout and the potential measure move back up here. We have key levels we're watching. Once we took out the 786, once we took out the descending support, we expect to just go up to our next target. And in this case, the next target being the 886. So our 886 is up here at $108. We know $100 is our first target because it's a nice round number. We know $108 was key resistance for literally, 4 different peaks basically around here at the 886 after the all-time high. And then we know the next target would be obviously the all-time high. And then after that, we can start looking at Fibonacci extension targets, 1.236, 5, 1.618. I don't think oil's going to get to $700 a barrel, but that's what we look at. It's not unrealistic to think oil can't get to 140 again, and if it goes above 140, it's not unrealistic to think it can't go to something crazy like 200 or 250 or whatever. But the realistic thing is okay, if oil goes to 250, what is $1 worth? Like, instead of pricing oil in dollars at that point in time, or rubles, or whatever currency you're using, maybe we should be pricing oil in gold, or oil in loaves of bread, or oil in, whatever other denomination you want to use that has historical principle and a clear relationship over time between those assets. And that's why it's so important for us to look at charts like, gold silver ratio, or gold Dow ratio, or, Bitcoin, crypto market cap ratio. All those things give us a relationship between one asset and another similar asset, because that takes out an extra variable. So right now, if we're looking at oil compared to dollars, but the dollar is moving and oil is moving, sometimes we're going to get distortions within that relationship. But if we have a historical relationship we can look at, which is like oil compared to gold or silver compared to gold or something like that, we can take out the dollar as the variable there, because maybe the dollar hyperinflates, so oil compared to the dollar looks crazy. And I'm not saying that's going to happen at all. I don't think that's going to happen anytime soon. But oil to a dollar might look crazy. Oil might be skyrocketing. It might be at $1,000 a barrel, but really the dollar is just worthless. But then when you compare oil to gold, it looks regular. It's like, oh yeah, well, gold's at 10,000, oil's at, 250 a barrel. But when you compare oil to gold, everything looks normal. It's only once you take out that extra X factor that you get a more realistic view of what's actually taking place. So that's why we look at those relationship charts often. And then just one more thing on the oil chart for the macro, and then we're going to spend a little less time on some of these other things, but these two are huge, and that's why it's so important right now. That's why, everyone's talking about oil now, but they were all so late to the party. So, I don't like to be a, contrarian, but most of the time, once everybody's involved in someone, everybody's interested in something, they're late to the party. The big move's already done. Then they're going to buy our bags. Then we're going to swoop and buy something else. And then we'll come back and pick up those bags later when they're 50% less heavy. So here we have essentially oil reclaiming the 200 exponential and simple right here, and then the 200 exponential going back to the upside. So we have reclaimed the bullish move on oil the same way we did back here, looking at like the 90s. We had a kind of choppy area right here. We lost the 200 exponential. We technically went into a bear market based on 200 exponential and simple. Both were sloped to the downside. And then we went into a long, long bull market. And that bull market technically started right around 2002. And it went from $20 a barrel to $140 a barrel. So we saw oil 7x. And we saw that trend basically until we lost the trend again, or, threatened the trend. We saw from 2002 to basically 2014, 12-year, oil bull market. So it's possible here that, maybe oil 7x's, maybe oil goes in a 10 or 12 or 15-year bull market, and that maybe it's the last bull market in oil. Maybe at 10x's, maybe at 20x's, maybe at only 5x's. But we know that there's probably some x's in oil's future, and it's probably going to take place over, 10 years or more, give or take. So if we're at $100 a barrel now, confirming back into the uptrend, or $75 a barrel now, a 10x in oil is $750 a barrel. So all of a sudden that doesn't seem as unrealistic when we look at historical moves in oil. Again, I'm not saying that has to happen, but more than likely, the fact that we have underspent or underinvested in oil for so long, and it's still an integral part of society and our function. And if we look back at historical uses of energy, we know for a fact that every time we've created a new form of energy or harnessed a new form of energy, we never stop using the old forms of energy. We merely just create more energy, more productivity, and do better as a human race. So even if we do get, even if we get nuclear fusion and fission become two main, principles again. We have our nuclear power back online. We have all these other great things online, wind energy and solar energy, and everything's more efficient. And now all these things are great, and we're harnessing star power, and just everything's phenomenal. The likelihood is, based on history, based on the human experience for thousands of years, we don't stop using the old forms of energy. We merely add more energy on through more efficient sources or new discoveries or harnessing that power. So the likelihood is that we don't stop using oil into the future, at least anytime soon, based on every other energy we've ever managed as a human race, to capitalize on. So to me, I think oil probably still does well, and I think it definitely does well over the next 10, 15, 20 years. So that being said, now we have the macro on energy, we have the macro on money, two things that are basically part of every equation. We know we need energy to do anything. We know we need money to fund anything. So now we can look at the prices, the valuations, the multiples, all those things with a more realistic and more open and broad idea as to what to expect into the future. Okay, so now let me jump in the chat here real quick. Everybody looking good. Good to see you guys. If you're new to the channel, make sure you like and subscribe. So now we went through a deep dive on, some key important things. Now we can actually just look at some different assets. We can do a little technical analysis, and we can have a better idea as to what we can expect longer term for some of these assets, and then we can look at some short-term stuff, etc. So here on the daily Dow Jones, what do we see happening here on the TJD Master? Well, it looks pretty clear, right? You know, we went into a bear market right here when they flipped over red. When was that? That was February 2020. What was in February 2020? Well, you know, we know what that was. And when do we go back into a bull market? Well, we flipped them back over right around here in July of 2020. Okay, so what has to happen for us to flip them back into a bear market again? Well, we have to break down below the 200 exponential and simple, and we have to spend enough time below them that the slope flips over red. Well, we've already seen it happen a couple times with the 200 exponential, and we're below the 200 simple. So we are now, for the first time since we went into that bull market, since we had a massive move to the upside, we're now threatening potential to flip into a bear market. So this is the most dangerous time ever. We're at a pivot point. We could easily pivot back to the upside and go to new all-time highs, and that's great, and everything's gravy, and you know, valuations are going to the moon. Does that seem realistic based on what we've just discussed? The cost of energy and the cost of money. Does it seem realistic that valuations continue to surge and that everything just goes up? Or does it seem more realistic that we're likely to enter into a bear market because money's getting more expensive, valuations are, you know, compressing, and things like oil, which are costs of production for these companies, which make up the Dow Jones, you know, a bunch of American companies that are trying to make money using oil or energy or whatever to fuel production, is it more or less likely that the multiples compress on these companies? The profitability compresses on these companies. You know, the economy slows, or does the economy boom? Does things get cheaper to make or more expensive to make? Can they continue to just raise prices on things, and will the consumer continue to pay it? Whatever business you have, whatever business we're looking at, to me, productivity into the future probably slows, at least for some period of time. Now, granted, you know, stock market always goes up, bro. That's what it's designed to do. There's more people, there's more money, prices go up, the economy goes up, GDP goes up, everything grows. There's more people to put into it, there's more money to go into it, everything grows. You know, dollar depreciates, stock valuations go up. Sure. But in the meantime, we have these heavy pullbacks, and our job is to protect our capital and make sure that we do not participate in these massive rips to the downside where we lose half our money. Because if we just get out of the way of these, we are exponentially better off. Let's say, for instance, here we have $100 right here. And we have two choices, okay? We can either exit when we confirm a bear market right here and get out with our $100, which will now go down to $67, or we can just stay in and just ride it out. And we can just be investors and just hodlers. We just hodl. We're hodlers. So the choice is, do you want to potentially de-risk and avoid that 33% downtrend, or do you just want to hodl out and buy the dip? Well, you can do whatever you want. But by using this strategy, we're able to protect ourselves from downside, because we might get out in a situation like this. Maybe we get out right here because it looks bearish, like in 2018. Maybe we get out, and then maybe we buy back in at the exact same price. Maybe we do. Maybe we buy back in at the exact same price. But we got out of the way. We got out of danger. We protected ourselves through the bear market. And then, assuming we didn't ever buy the dip this whole way up, we could just rebuy when it's bullish again at the exact same price. And we sleep at night. We don't have to worry about a long-term crash. We don't have to worry about a sideways market that lasts, 11 years like has historically happened previously. We don't have to worry about that. So you could do whatever you want. Me personally, I like to de-risk. Same thing we did here. Sold out when we went into a bear market. We revert to the mean, we fail, we come down, we get out of the way. And then we can start just buying back in with that same money. So if you just kept your same money right here and you didn't change anything, and you just kept that $100, and then it went down and then it went back up, you had that same $100 back here in November of 2020. And then after that, it finally just went up and you were good to go. And then you're, oh, thank God. And then we've only seen higher prices since then. So that is definitely an option. But if you took that same $100 here and you got out and then you bought the 821 cross back to the upside right here on the daily, said, okay, this is starting to look good now. Just when we get back to that same price again, now we're up an extra 20%. So if we're now up an extra 20%, what are we up now from that point? Well, if we just held and nothing changed, we held through the down, we held through the up, and then now here where we're at right now, well, we're up 24%. That's great. Well, wait a minute. But if we did this, if we did my strategy, We're up 24% just when we get back to normal right here. So what are we up now from that point? We're up 53%. So not only did we protect ourselves from downside losses and be able to sleep at night and not have to worry about some lost decade or whatever the worst case, crash, horrible scenario is, not only do we not have to worry about that, but then on top of it, now, just with a simple strategy and one extra trade, we got out one time, we got back in one time, and now instead of being up 24%, we're up 53%. So that same $100 that would be $123 is now $153. So we doubled our gains. We were twice as productive in the same amount of time with a simple strategy like that. And that is why I use this strategy for long-term investing based on things that I'm already fundamentally bullish on, like, for instance, the U.S. economy and largest indexes, Dow Jones, etc. Now, that does not work for everything, but for trending legitimate markets with actual fundamentals, earnings, valuations, etc., it works perfectly. It works for most things, but longer time frame investing. So now we're looking at that same danger zone right here. So what are the two scenarios that could possibly happen? Well, the bullish scenario is we reclaim that level, it flips back over green, or blue, we go back to the upside, and that's it. But we protect ourselves. Now, what's the bearish scenario? Well, maybe we sell off 10% and then we buy back in on the 821 cross back to the upside. Maybe we sell off 30% and we buy back in on the 821 cross back to the upside. Maybe we sell off 50%, 75%, 100%. Goes to zero. The world ends. Who knows? We don't know. But by just simply protecting ourselves, at least we get to sleep at night. And regardless, there's a very high probability that when we get back in, we get back in at a lower price. So that's what I'm looking at. That's what I see on the Dow Jones. We have key levels we're paying attention to. We're potentially getting ready to break down from those key levels. So I do not like the way this looks right now. And this is one of the stronger indexes. And when we look at longer time frames, weeklies and monthlies and all this other stuff, we see we have bearish divergence. We're running out of energy and prices were surging higher. We know that there's a high probability that this will not continue on. And if it does, we just get back in at the same price. Maybe a little lower even. Maybe a little higher. But that's us. We're just, I used this analogy the other day in the group. We're paying for insurance. You pay a small premium to insure yourself from a car accident. So think about that as the same thing. We get out of the market in case there's a crash. We buy insurance in case there's a crash. We pay a small premium in case there's a crash. And that's exactly what we're doing here. So to me, Dow Jones does not look good. And if it does look good, we're going to know very soon. And we'll know a couple percent from now. I mean, in order for this to switch back over to bullish from where it's at right now, it needs to at least go up 3%. So we can know in 3 or 5 or 7%, we're bullish again and we can get back in and everything can be gravy. Or we can potentially avoid, a 30-something% downside or 20% or 10%. So to me, the risk reward ratio right now tells me that if it costs me 5% to protect myself from 10% or 20% or 30% or 50%, or if you listen to one of these crazy bears, 80%, I would gladly pay 5% to protect myself from any of those because the risk reward ratio is exponentially higher. A risk reward, if we have 10% potential downside and 5% potential upside before we have to be wrong, admit we're wrong, and buy back in at a higher price, that's 2-to-1 risk reward ratio. I'll take it. We flip a coin, and if we're right and we go down, we get $2. If we flip a coin and we're wrong and we go up, we lose $1. I like those odds. So that's how we look at it. Risk reward ratio, we need to pay attention to position sizing. We need to trade with the trend, and that gives us an edge with the highest probability of success over time. So now let's look at SPY, SPY, S&P, whatever you want to. What do we see here? Same thing again, okay? Bearish, sells off massively, recoups around the same level roughly. 821 cross back to the upside at a much lower price. We could re-enter at 261. We go into a bull trend. We threaten the trend once or twice. Nothing serious. Continue to the upside. We have another potential reversion to the mean. Continue to the upside. And now here we have broken down below it. Here we have broken down below it a second time with a lower high, potentially showing the start of a downtrend. We will know officially if we take out this low right here on a daily candle close that we now have a high, a low, a lower high, and then potentially a lower low, which is the start of a downtrend. We'll be below the 200 exponential and simple. The 200 exponential slope has already flipped over red. The 200 simple slope is damn near flat at this point in time. We are very close to, as far as my indicators, my strategy, how I look at things, we are very close to confirming a bear market on the S&P as well. That does not look good to me. I am de-risked, protecting myself. I have bought the insurance and I'm sitting around waiting to see if the semi that doesn't look like it's going to stop at the stoplight T-bones the next car that goes through. So while everybody else is driving through, buying the dip, getting T-boned left and right, we're just sitting there eating popcorn. IXIC. So Nasdaq is next. Now, we see the Nasdaq has done something differently. Again, we see the same exact thing happening over and over again. You know, bear market, break back above, bull market, bear market, break back above, bull market. And now here we are retesting and breaking down below the 200 exponential and simple. So we are here in the Nasdaq. So maybe we already bottomed. Maybe we're here, and we're going to go back up from here. Maybe we already bottomed. That's fine. When will we know? Well, let's look back here. Where would we have rebought into the scenario? So we got out at the 821 cross, or we got out at the bear market, depending on what time frame, or you know, if you're scalping or if you're investing or whatever. But we have de-risked, and here we get back into the trade. So if we're going to do the conservative, or we're going to do the aggressive thing and get out at the 821 cross, you know, before we get back in, price is down 20%. So we get to buy 20% more of the Nasdaq if we wait that strategy. If we wait the other strategy and we just wait for the 821 to cross to the downside and the 200 exponential and simple to have a negative slope, we buy in right here. So then from there to there, we get 8% more stock. So we get the same stock and we get 8% more of it for nothing, just for saying we don't want the risk. And then the market says, wow, great decision. Here's 8% extra because you're smart and you didn't want the risk. And we're like, oh, that's great because we win-win, right? Perfect. That's our strategy. So next, we move back on top of here. We can, you know, continue to the upside, bull market the whole way up. Maybe we de-risk in a couple of spots. Maybe we, you know, protect ourselves with options. Whatever the situation is, whatever your trading strategy is, that's fine. But now here we are at that same situation where we've had the 821 cross the downside. We are now, confirmed in a bear market. You know, we've had the 200 simple kind of going back and forth between blue and pink. But here we are very clearly red on the 200 exponential. We're very clearly getting rejected from the exponential and simple moving averages. And it looks like we're going to be putting in lower prices. So again, we have a high, we have a low, we have a lower high, we have a lower low, confirmed downtrend, another lower high. Are we going to get another lower low? Well, probably, because that's what a downtrend is, a series of lower highs and lower lows. So where's the next low going to be? Well, we can look at our support over here. It's probably going to be at 13,000. Maybe it's going to be down here at 12,600. Maybe it's going to be down here at, 11,926. Maybe it's going to be lower and lower. I mean, it depends who you ask. But regardless, we know right now that we're in protection mode. We're in a bear market, 100% in a bear market. And again, if we look at individual stocks inside of this index, the Nasdaq is down from the literal tip to where we're at right now is down 16%. That's a lot. Technically, Wall Street requires a 20% drawdown before they consider this a bear market. Now, how many individual stocks inside of the Nasdaq, especially ones that don't make dollars, so they don't make sense, are down 75%, 80%, 90%, 50%, 40%, lots and lots and lots of those. So we know that only a couple stocks, the FANG or our readjustment of the FANG stocks are what's holding up this index, and the index looks weak. So they're barely holding it up. So what happens if Apple starts to crash? What happens if Microsoft starts to crash? What happens if some of these other big companies, Google or some of these other ones that have stayed strong start to sell off? Well, this is going to get absolutely wrecked. Because I'm going to tell you right now, if the strongest stocks are selling off, what's going to happen to the weak ones? What's going to happen to the companies that don't make money? They're going to get absolutely wrecked. And you're like, yeah, but they're already down 90%. This is deep value territory. Kathy Wood told me so. Well, is it deep value territory? Because she was saying it was deep value territory at 15% down, 20%, 30%, 40%. Now you're down 50% on her funds. And she's saying it's deep value territory. Well, that sounds a lot like the girl who cried wolf to me, okay? If every time we dip, you say, this is it, I'm buying the dip, I'm buying the dip, I'm buying the dip, and then eventually you lost all your money, and then I come up and I say, this looks pretty good to me, I think I'll buy the dip now. So she's like, you're betting against innovation if you don't believe in my ARK stocks and you don't believe in these funds. Am I betting against innovation, or am I just smarter than you? Because if you loved it at $100, you got to fucking absolutely love it at 50, right? If it was good at 100, it's great at 50. So maybe you were betting on innovation in a bubble, and I'm betting on innovation at the bottom. And I'm still not betting on innovation, okay? I'm not saying Kathy Wood won't be right in the long term, but she's not doing a good job at her job. So if your job was to be the weatherman, and you said it was going to be sunny every day, and for the last year, it rained every day, and you lost half your viewers because it rained every day, and you said it was going to be sunny every day, are you doing a good job? No. So that's what Cathie Wood's been doing. For a year, she's been saying, I have a 5-year time horizon. It's going to be sunny tomorrow. It's going to be sunny tomorrow. It's going to be sunny tomorrow. Every day it rained, and half her viewers are gone now. Half the value of the portfolio is gone now. So maybe it will be sunny, and maybe you'll be right. And for the next 3 years, it's going to be sunny every day. Well, who cares? Nobody anymore, because you lost all your credibility. And that's why it's so important to think broad and then think short term, and then have a definable way that you're going to determine if you're going to get into a trade, if you're going to get out of a trade, if you're going to get into an investment, you're going to get out of an investment. Because I can believe in the future of energy and all this cool innovation and stuff. I believe in that. I think it's great. I think humankind will advance itself over time. But if we're early, we're still wrong. So we have to figure out how we know if we're early or not. And that's how we use this strategy for investing. So Russell is next. So Russell, we've been trading sideways inside of this range for over a year on the Russell, just bouncing around the channel. We had a throw over, a failed breakout, a trick, a trap, a stop hunt, whatever you want to call it. Then we come down, then we broke down from that key support here in green. We came down and we touched our first Fibonacci level from the bottom all the way to the top, the 236. We got a bounce, we came back up. We tried to reclaim those levels, we got rejected. We're very, very clearly in a bear market on the Russell. We see the slope lines have flipped over. We're in a bear market. What happened last time Russell went into a bear market? Well, let's look. Here we had the Russell goes into a bear market. We exit our positions. We de-risk. Russell goes down, 40%. Okay, so we don't know when to buy back in, so we just use our regular strategy, bear market. So we're just going to buy back in on the daily 821 cross. So we get a 25% discount. So now we get to buy back in 25% cheaper. Maybe it comes back up here, gets rejected, goes lower. We take profits along the way. Maybe it continues to new highs. Once we consolidate back inside the bull market, say we sold here because it was bearish, say we waited and just bought back here. Once both of them flip back to the upside, we still got a better price. Or regardless, we could put that money to use somewhere else over that time period. Even if the money was worth the same, even if the stock was worth the same, we de-risk. So we slept good at night, we put that money to work somewhere else, and then when it was all said and done, we got the same amount of stock back. However you want to do it, that's fine. This is all up to you guys. It's not financial advice. I'm telling you what I do, and you can go back and back test it and see that it works, and then you can do what you want to do based on whatever you see, whatever you believe, whatever you like, whatever you don't like, whatever. That's fine. We all have to do ourselves. Some people are not going to be able to look at charts all day, every day, or want to look at charts all day, every day. Some people just want to make, a buy and leave it alone for 20 years, and that's fine. Or make 2 trades a year or 5 trades a year. That's all up to you. That's all up to you. And you can use this same strategy in any of those ways just by looking at different time frames. So here we see on the Russell, we broke down from key levels. We're in a bear market. We're getting rejected. We were close to getting the 821 cross back to the upside. If this crosses back to the upside, what do we do here? Well, technically we buy. And then we see what happens. Maybe take some profits along the way. Maybe we wait. Maybe we just trail our stop loss. But if this 821 cross back to the upside, technically we buy. But that didn't happen. It got rejected. So maybe market makers, maybe whales, maybe other people are using the same strategy as we are. Ooh, that sounds like a good idea. If we do what all the smart people with the millions and billions and trillions do, and we do it when they do it, instead of swimming upstream, we're sitting on our floaty and we're floating downstream, drinking a beer, counting our money. And that is the strategy as a whole. So that's what we're going to keep doing. Russell looks terrible. I suspect it continues to look terrible. If that changes, sure, we will change as well. But in the meantime, still looks absolutely horrendous. We look at a couple more of our indexes, and then I'll jump back in the chat here if you have any questions, comments, anything like that. If you're new to the channel, make sure you sound off so I can say what's up to you. If you just found us here, this is our new stream time. We stream every day. Every Wednesday and Sunday at 8 p.m. Eastern Standard Time. And now every Friday, we're going to be streaming at 11 a.m. Eastern Standard Time. So here we have XLE. So this is our Energy Select Sector ETF. So this is basically, our oil, our nat gas, all that junk in here, just energy as a whole. So energy is the strongest right now of our sectors, we can look at. Now on the macro, it's not, because it's not even at all-time highs. Everything else in existence is at all-time highs, over a long enough time frame, but energy. But energy is the strongest short term. So it's the worst long term, but it's the best short term, depending on time frame. But that's what we're paying attention to. Now, what does energy look like it's doing? Well, it looks like it's rolling over. We see oil is probably topping out. We see XLE is probably topping out. So we're looking to buy the dip, though, because we're in a bull market now. We're above the 200 exponential and simple. We're way above it. So we're looking for the reversion to the mean play, but we're expecting the trend to continue to the upside, and we're looking to be a buyer of that 200 exponential and simple when we come back down to it, or one of these other key levels, maybe 58, maybe it's 55, 56, somewhere around there. But we see the sell by sell, we see a bunch of red histograms, we see the 8 and 21 getting ready to cross back to the downside, so we're looking to buy the dip when it comes down here. Now when it's red, we're looking to sell the rip. Every time we get a rip to the upside, here we go into a bear market in 2018 on the daily. So, we don't buy the dip here because it's bearish, so we expect lower prices. So instead, we sell the rip. When we come back up here and we top out at 200 exponential and simple, we sell. We sell. We sell. We sell. We sell. Oh, but it's not working. We're barely making any profits. We would have been just as good buying the dip. And then eventually, look what happens. The market proves us right. Because this was the big sell right here. And then what happens here? You sell the rip. And then what happens here? Oh, something changed now. Now we're above the 200 exponential and simple. So now instead of selling the rip, we're buying the dip. We're buying the dip. We're buying the dip. We're buying the dip. And look, we keep being right. We're buying the dip. And now what happens next time? We buy the dip. And then what happens if we get below those and they flip and they turn over? Then we sell the rip again and we go back into a bear market. And we just keep it simple, stupid. Kiss those profits, put them in the bank, and enjoy it. We do it the easy way, okay? I'm not trying to work hard around here. I've lived too long to work hard anymore, okay? I work smart now. XLF, financial sector. So what's going on with financials? There's a lot of headwinds, a lot of tailwinds by the banks. The PayPal and innovation and crypto is going to upset them, and banks are going away, and the Federal Reserve is going to make banks irrelevant, and there's going to be a central bank digital currency, and okay, all those things. I can literally take both sides of that fundamental argument, and we can have a debate, and at the end of it, we can shake hands and go, damn, you made a lot of good points, and I can take either side of that, and I can make a lot of good points, and we can shake hands at the end, and nobody knows who's going to be right, but we can talk about it in 10 years or 20 years or 50 years, and we'll have proof. But in the meantime, let's just look at the technicals. So we know that there was a bear market. We know we entered into a bull market. We know we're back at the 200 exponential and simple. So why aren't we just buying the dip right here? Well, we see something starting to happen, a trigger, something telling us, wait a minute, there's things changing. Here, the 200 exponential is clearly above the 200 simple. Here, we start to lose momentum. The 200 simple crosses above the 200 exponential, and now we see we're losing momentum. So oftentimes, we get that cross to the upside, and we continue to put in higher highs, but we start to see weaker bounces off the moving averages, and then eventually we break down, and that is how the bear trend often starts, on a casual top. Now, on a blow-off top, you don't see that in the same way because you have an aggressive move to the upside, and by the time that happens, it's too late, and we're already in a downtrend. But in a rolling correction, in a rounding top, like what we're seeing here on financials, we see this signature taking place. And that, to me, is, wait a minute, we probably do go higher, but let's start to take some profits off the table. Let's start to de-risk. Let's expect this maybe not to keep doing what it's been doing. Now, how do we know if we're wrong? The 200 exponential comes back above 200 simple, and then we powerfully move to the upside. That's great. We're back in it to win it. How do we know if we're right? Well, this breaks down here and then starts to put in lower lows, and then eventually the 200 exponential flips over red, and the 200 simple flips over pink, and then we go into a bear market, and then we're right back at our same strategy again. So we're just doing the same thing over and over again, but we're complicating it by just adding in additional steps along the way that they're easy to see, they're easy to follow, they're just simple. We can go down a checklist. Is the 200 exponential above the 200 simple? Yes. Do they both have a positive slope, blue, and to the upside? Yes. Bullish. Now we look at that same checklist again. Are they still sloped to the upside? Are they still blue? Is the 200 exponential above the 200 simple? No. Okay, hang on. So let's look at our flow chart now. So do we probably put in a new all-time high? Yes. But do we probably run out of steam and break back to the downside and potentially threaten this? So should we de-risk or take gains? Yes. How do we know if we're wrong? The 200 exponential crosses back above the 200 simple. How do we know if we're right? We start going through the checklist for a bear market. Are we below the 200 exponential and simple? Is the slope red? Is the slope pink? Are we going to the downside? Are we now selling rips instead of buying dips? So here we see a potential double top in financial sector. So now I'm looking at UPS just because I use this as kind of a proxy for transportation at the moment. We can look at all the different sectors and everything, but what I'm seeing right here is we're basically just chopping sideways inside this range forever. We're filling all these various gaps. We're taking profits along the way. We're having some nice trades, and then we see this happens. Earnings come out, it's a beat, it's a gap up, and then it's a failed breakout, a throw over or a failed breakout. And we discussed this ahead of time, how this looked like it was going to fail. And now look, all that's happened is just continues to sell off. And now look, the 200 simple, we're still above it, and the slope is negative. Well, we saw the 200 exponential lose the slope. Now we're seeing the 200 simple lose the slope, and we're above it. So what is our warning sign right here? Okay, the 200 exponential was above the 200 simple and then lost it. 200 simple is above the 200 exponential. We retouch the 200 simple. We retouch the 200 exponential. Is UPS topping out? Is, and this is the best transportation, shipping company. Like FedEx is horrible compared to this. Jets is horrible. Cars is horrible. Various other ETFs as opposed to just this company. So we're looking at the fastest horse in the race and we're saying, hey, this thing looks tired. Like it looks hurt. It might need a break. It may, go into a little hibernation period here. So what is this telling us about the world if we're starting to see, shipping and transportation and oil prices and, cost of money or interest rates all looking like, hey, maybe they're getting tired. Maybe they're going to relax for a little bit. Well, it tells us that probably what we suspect and what we see happening in all these other stocks and housing and crypto and all this stuff, we see these evaluations are probably going to be compressing. And that's that multiple compression again that we've been discussing. So what's going to happen here? Well, we wait and see what happens, but we're just filling the gap. So we come back down a little lower to 202. We fill this massive gap here in red. And then after that, we see what happens. Probably come back down to the bottom of the range. Probably end up being a topping pattern. So what is this we're seeing right here? A big range with a poke out the bottom. And then, a bunch of the same tops. And then one big push out the top. Well, this sure looks like Wyckoff distribution schematic 2 to me. We fake breakout to the upside after a fake breakout to the downside. That's our spring. This is our throw over. And then distribution has taken place and then we go much lower. Looks likely. Got to be careful on this one. So that's it for those. I'm going to jump in the chat real quick, see how everybody's doing. Grab a quick drink of water. Not going to take a break though. We're going to keep ripping. All right. We got us another bot. Bots in the chat. Hello, 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 hello. So weird how YouTube can't stop bots at all ever, but somehow can flag comments that actual subscribers and real people leave for review. That's so weird that they can't figure that out. Their crazy algorithms can figure out how to censor certain words or things that I say or shadow ban me, but they can't figure out how to stop very clear bots. That's weird, YouTube. CW says, when you say de-risk, are you including bonds? Yeah, look, CW, you got to do what you do, man, but I have no interest in bonds right now. In the words of the great and most of the time wrong, but occasionally very right, Peter Schiff, bonds are reward-free risk. You take all the risk and get no reward. So you commit to a period of lockup on your money that we know is depreciating in value. So we know that when you get back that same money in the future, it's going to be worth less because of negative interest rates, essentially, or real rates. If we're going to pay you 1%, but inflation's 7%, by the time you get it back, you lost 6% in 1 year. That's terrible. And then on top of that, we've been in a 40-year bull market on bonds or bear market on rates. So if the breakout happens, if the trend changes, more than likely, what's going to happen? Well, the rates are going to go up and then the principal is going to go down. So our principal is at risk and we know we're losing money by putting that principal up. So if I was like, hey, let me borrow $100 and there's a really high likelihood in the future that not only am I going to pay you back less money because of the interest rates, but I'm probably you're going to have less purchasing power for the money I do give you back, but I'm also probably not even going to give you back the whole 100. So I'll borrow 100 from you, I'll give you back that 100 in the future, but it's really only going to buy you $20 worth of stuff. But really, I'm probably not even going to give you back the 100 that'll buy you $20 less worth. I'll probably just give you back $50. So I'll borrow $100 from you and then I'll give you back $50 in the future. But because of inflation, you'll probably only be able to buy $25 worth of stuff. So you give me 100, I'll give you back 20 or 25 if you're lucky. How's that sound? That's what I see when I see bonds right now. That's what bonds look like to me. Now, does that mean you should invest in stocks? Does that mean you should invest in gold? Does that mean you should sell all your bonds? I mean, it's different for everybody. But for me, I do not see an upside in bonds right now. I would literally rather sit on cash and not risk my principal or buy gold. Here's the thing about gold versus bonds and why we'll talk about gold and the breakout and potential store of value and, it doing its job. if inflation is a legit threat or if deflation is a big threat. Because a lot of people think that gold only holds its value in inflationary environments, but gold actually does extremely well during deflation as well. So think about it like this. If I have $100 and I'm going to risk it in bonds to get back 1%, which I know is not going to beat inflation, the only way I win on that trade is if the actual bond appreciates in value. You know, if that $100 principal goes up and somebody else is willing to buy that same bond from me for $120 because they want the bond. So basically the interest rate is irrelevant. The coupon is irrelevant. So I'm basically just speculating on the price of the bond now, that it will go up. Therefore, I will make money or at least break even with inflation. So the argument between a bond and gold is now the gap between them is way less. So if you now say, hey, if I'm going to give you basically nothing for a bond, do you think it's going to go up? Or I'm going to give you literally nothing for gold, do you think it's going to go up? Which one would you rather have? Well, then I just look at it as, okay, if there's no real upside, what is the downside? Well, the downside is that rates go up, which it looks like they're going to do. So then the bond's principal is going to go down. So that looks like bad to me. So then what's the alternative for gold? Well, if rates go up and inflation hits, gold probably goes up. So that looks good. So bonds look double bad and gold looks bad and good. And then realistically, you know, when you start evaluating those things and you say, okay, well, even if gold doesn't go up, is it going to maintain my purchasing power in an inflationary environment? Yes. Historically speaking, yes. And then you look at it and say, okay, well, is there a chance that gold also appreciates faster than bonds? Well, yes, definitely. So when I start checking all these boxes between gold and bonds, gold looks exponentially more valuable to me. Now, when I say gold, I use gold as a proxy for like buying coffee and sugar and wheat and corn and all the other various commodities. Like if we're going to see inflation, commodities are going to get more expensive. Lumber, all this stuff we see going up. Oil. But I can't just buy barrels of oil and a bunch of extra wood and, you know, a silo full of corn and a bunch of wheat and, you know, tons of coffee and just put it all in my backyard because, you know, bugs will get into it or it'll get stolen or whatever. So that's where gold comes in. You're just storing your value to buy the other things that you want, the commodities. And people forget that that was the actual purpose of gold. Someone spent a bunch of energy to get a shiny thing that's functional and valuable and real money, and then you can just trade it for the other things that you want. But you could bury it in the ground or put it in a safe, and you don't have to worry about it going bad or getting stolen or what. Well, it could get stolen. Anything can get stolen. But you see my point, though. So I don't see any upside in bonds, me personally. Ralph Smith says, when you say sell the RIP, are you shorting? I assume you sold your position once we go into a bear market. Now, it depends what we're talking about here. So there's multiple ways that you can do it. You know, and obviously it's not financial advice, but say I have a Bitcoin position and then we go into a bear market, I'm no longer going to be long on Bitcoin. So on my investment position, maybe I still have some Bitcoin that I'm not going to ever sell because it's an investment and it's profits that I'm just forgetting about. So maybe I'll hedge that by shorting. Maybe I'll use futures. Maybe I'll use options, you know, depending on what asset we're looking at. But the most important thing is that instead of being in a bull market, I'm net positive and I'm buying the dip. I'm adding to my position. I'm levering up. I'm putting more money into the market. I'm doing the opposite in a bear market. So if I have a position still open and then we confirm into a bear market, I'm waiting for that reversion to the mean play, whether I scalped it on the way up or whether I still have a position that I'm trapped in underwater or up, but you know, I'm giving back some of my gains. Then is when I say sell the RIP. So I'm either shorting, I'm using options to protect long-term investments in like stocks or Bitcoin or whatever, or I'm, you know, just shorting that actual position to go flat or shorting it to go net negative, or I'm selling off spot, you know, selling off Apple stock, like whatever it is that we're looking at. It doesn't matter how you're doing it and what strategy you're using. The most important thing though is that I'm trading with the trend. When we're in a bull market, I'm buying dips. When we're in a bear market, I'm selling RIPs. How I do that, what strategy you use to do that with, there's a million strategies. If I have spot and we go into a bear market, when I say I'm selling the RIP, I'm probably selling off my spot that I still have remaining. But the majority of it, I probably have already gone flat on because you guys know that I'm a conservative investor. So when we start threatening a bear market and things don't look good to me, I'd rather just de-risk and then protect my principal, protect my capital. That's the most important thing to me. So now if you're a more aggressive investor and you just buy every dip until we confirm a bear market, that's perfectly fine too. But then once we have that reversion to the mean and it fails, that's when you need to be exiting your position and going net negative. Or I do anyway. Again, not financial advice, obviously. If you're just tuning in too, obviously, none of this is financial advice. It is all for entertainment purposes only. I'm sharing with you my strategies and what I like to do. These markets are extremely volatile. Please do your own research, trade responsibly, protect yourself. Just educate yourself is the one thing I ask of everyone. Spend the time, spend the effort, and learn for yourself so you don't get trapped because you're following some YouTuber who is telling you do this, do this, do this, and then the next day they say, okay, I did the opposite. And you're like, what the hell, man? And then you have to figure out what you're going to do because now they stop comments and they're not showing up anymore and they're whatever. Just the most important thing, the one thing you can never lose, no one can ever take away from you, is education. That's why, it's so important to just learn, put in the time, put in the work, put in the effort, put in the money, whatever, and then learn a skill, learn a trade, get better at something, and then be self-sufficient so that you can take care of yourself, your family, and those that you love on your own. And that's what it's all about. That's why the education is so much more important than what I'm actually telling you, I do, or what I think, my opinion on something. If I was in a situation, I would rather you guys learn exactly how to do all this stuff on your own. And then you can be completely self-sufficient. You don't need me. And you can use responsible, realistic strategies that I have developed over, 10. Some of these strategies are only a couple of years old. Some are 10 years old. Some are 20 years old. Some of these are hundreds of years old. And I've just adapted them myself from other people that were much wiser, much more intelligent, Charles Dow theory, Fibonacci, moving averages. All this stuff is like hundreds of years old. And it's proven. I've just adapted it and fine-tuned it and created indicators that make it easy on the eyes and easy to follow and easy to do. Just because it's easier for me, when I look at 100 charts, I can see, okay, blue and green, we're bullish. Red and pink, we're bearish. And then I can look at all these other things as I want to dive deeper in and look at momentum and look at indicators, oscillators, all that stuff. Ralph Smith says, do you use log for every asset? For the most part, you'll see like I have some charts, a lot of charts drawn where I actually have drawn in log scale versus like here, we can look at actually the TNX chart. That's one I specifically have right here where I actually have it drawn both ways. So let's turn off the moving averages. Oh, I think TradingView was doing something janky last time on this, so we'll see what it looks like. So here's on log scale, and I have, I think it got rid of my other arching line. So let me add that back in really quick. There was something janky going on with TradingView. I don't know what it was. They didn't update, which they actually fixed a bunch of stuff, which is good. But in the meantime, they also messed up a bunch of stuff too. So we had something like this going on. Essentially something like this going on. And again, it doesn't have to be perfect. We can go through and fine tune it. I think I actually had it like slightly lower. But regardless, what we're looking at is we have a clear resistance here at the top that we've been bouncing our head on a bunch of times. We have a clear support here at the bottom that we've been bouncing off of a bunch of times. This is in log scale. And then we obviously have the heart line. We interacted with a ton here, a bunch through here, a bunch through here. And we see clear bounces off of it, rejections and support. And then if we just switch this over from log scale, we see now and I'm going to delete both these just to make it a little more clear. This is not log scale. This is just standard. And now we see that same channel that we were operating inside of in log scale is actually a very clear channel here in green with very clear support and resistance on the treasury yield. Every time we touch the bottom, we bounced. Every time we touch the top, we got rejected. So sometimes it will be more clear in one chart or the other. Sometimes I'll draw both. Usually I just do what one works the best and two, what I think other people are looking at. Because in the end, that's what technical analysis is really all about. It's really just all about figuring out what everybody else is doing, what everyone else is looking at, and then doing the same thing. Because we can't make a market. We definitely can't do it by ourselves. But if we can figure out what the market makers are doing, it gives us an advantage or some sort of edge using our technical analysis. So Shit poster says time to buy the dip. No need for all the lines. Just buy the dip. By the way, have a look on the ICICB blockchain. I'm sure you will like it. Okay, great. Thanks for sharing. So anyway, let's just keep ripping through here then. It's hard. You got to understand, man, it's hard for me to take anyone with the name shit poster seriously. So, DXY. So DXY obviously looking strong here. You know, we're well above the 200 exponential on simple, clearly trending to the upside. We're obviously having a little consolidation in this range right here on the daily. This looks to me like a bullish reset. Okay, everybody hates the dollar. The dollar's garbage. They're printing them out of control. Dollar's going to zero. Well, it doesn't look like it. It doesn't look like it compared to other assets. It doesn't look like it compared to, you know, the basket of currencies that it's compared to right here. So let's look at the weekly and see what we see. Okay, so weekly, we had a pretty big bull market here, consolidated for a bit, reclaimed the bull market here, you know, went into a bear market right here, and now look what's happened on the weekly. Oh, bull market again. 200 exponential and simple, angle to the upside on the weekly. We're above both of them. We're consolidating above those levels with a positive slope on the 821, so it looks bullish to me. Monthly, well, we've been in a very clear downtrend on the monthly since the 1980s. So we have a high, we have a low, we have a lower high, we have a lower low, we have another lower high. So very clearly, this is a downtrend. We are definitely in a downtrend. Now, because these 200 monthly exponential and simple moving averages don't go back that long, we can't really see a previous time when they were bullish. We see the end of the 200 exponential being bullish right here, and we know that the 200 simple was probably bullish somewhere around in this level. There was sort of a bull market here, and we sort of went up, you know, and put in a lower high. Well, we're seeing that happening again. We reclaimed here in 2014 the 200 exponential. We flipped the 200 simple back blue temporarily, and then eventually came back down and retested both the 200 exponential and 200 simple perfectly on the monthly. And then we came down and we found support at the 200 exponential right here. I was screaming at the top of my lungs how bullish this was, double bottom, bullish divergence on various time frames, etc. Everybody was like, dollar's going to zero, they're printing too many, bro, the Fed. Keep in mind, this is the DXY. This is the dollar in relationship to other countries' currencies. The basket of currencies, but I use it as a proxy for the dollar strength compared to other countries' strength in their, you know, quote unquote money or currency. So we see a hard buy coming out of the bearish control zone. We see a bunch of green histograms. We see the slope line is flipped over blue. We're above the zero line, all bullish. Here we see coming out of the bearish control zone, cross to the upside, hard buy signal. And we see now we're inside of the bullish control zone, angled powerfully to the upside, all bullish. We see here the 200 exponential is blue, 200 simple is blue, the 8 and 21 have crossed to the upside, all bullish. We're still inside of a macro bearish downtrend, but everything is bullish. So what is our target to the upside? Well, we have a couple different areas. We know we have basically a high right here. We know we have a previous high right here. So maybe we come back to 99 or 100. Maybe we come back to 102. Maybe we put on the macro chart. Let's turn off our moving averages. Not going to go into detail on this chart because it is a little wild right now. But we have obviously a resistance, and then we have a potential top for a resistance somewhere out here into the future off of that yellow trend line. So for me, the likely top on the dollar is probably 109. And then if we just look at, you know, the time cycle analysis that I have in place right here, we see that we have a top right here. We have a top right here in yellow. 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 So the next potential top based on time cycle analysis, and we can skip some of these and just go every other one. We can do whatever we want and look at where these various tops are at. But it looks like potentially to me that the top will come in somewhere around June 2024. Now, time cycle analysis is much less accurate, but we know realistically that it probably tops out around 110. If it breaks above that level, we know something has changed and things have gotten crazy around the world. And if it, you know, doesn't make it to that level, we can reevaluate. But as of right now, DXY, dollar strength, extremely bullish to me. So what does this tell me? If I'm going to invest in, you know, stock market or real estate, where am I going to do it at? Am I going to do it in the United States or am I going to do it in Canada? Am I going to do it in the United States or am I going to do it in the UK? Am I going to do it in the United States or am I doing it in Europe? Or, you know, obviously those are some of the currencies that this is directly compared to, but we can look at, you know, China or Japan or some of the other currencies around the world and say, okay, is the dollar strong compared to other currencies or weak? So in this case, against this basket of currencies, we know the dollar is strong and strengthening and likely to go into a multi-year or decade uptrend. Therefore, it tells me that if I'm going to invest in a stock market, am I going to invest in emerging markets? No, I'm not. Everybody's like, emerging markets is the time, deep value territory, the multiples have already compressed. Well, they're probably going to keep compressing according to what's going on right here. So I'm very bullish on the DXY, on the dollar in relation to this basket of currencies going into the future based on technicals, not based on my thoughts or feelings, based on moving averages and math. All right, so TSLA, Tesla. So we obviously put in a top right here at the 1.618. Obviously Elon Musk was able to nail it perfectly. So, I mean, is it realistic to think that the richest man alive that's making rocket ships that go to Mars and, electric cars and all this like innovation, is it possible that he or someone that worked for him uses or knows technical analysis and uses the same strategy we do and was able to predict the exact top off of the previous high to low? I mean, sure looks like it to me. I don't think that was a coincidence. I think he could probably afford the best software programs or bots or, technical analysts to tell him, hey, now's probably a good time to sell. Since that time, we have a high, we have a low, we have a lower high, we have a lower low. So what's more than likely going to happen? Well, we probably keep putting in lower highs and lower lows. So Tesla does not look good to me. We had a consolidation period here, and then we continue to the upside. That's fine. That's great. That's grand. But now here, we're losing the slope on the 200 exponential. We're at the slope, 200 simple right here. Doesn't look particularly good to me. Does not look good. Looks stronger than most, but doesn't look good right now. So we're seeing Intel did something that we've been predicting for some time now. Obviously, you guys know how I feel about Intel. It is the worst semiconductor company. It is total trash. It is the worst place you could put your money. We just had the biggest semiconductor bull run in all of existence, and Intel did not even make a new high since 2000. So probably not a good thing. We see triple bearish divergence on the monthly chart. Not going to go into like the big long chart, but we see we're basically down at the support level. I told you guys I expected this back down in the 50s and then the 40s, and then eventually I actually expect it much lower. You guys know I have a target for Intel down here in the 30s. I don't know how low Intel will end up going. I don't know when this new foundry will develop. I don't know when things will shift with them. So this could, this is obviously a very long-term view, but in the meantime, Intel does not look good to me. It looks absolutely terrible. And the fact that this is basically the weakest in the semiconductor space, and then we'll look at NVIDIA next, which is the strongest, and neither one of them looks particularly good, tells me that I'm probably going to be right about semiconductors topping out and about energy potentially blow off topping out at some point in time in the near future, and probably rates, bottoming out or bonds topping out, and all these things that we've been discussing are probably going to play out. Now, will I shift my view if something changes? 100%. I don't want to be right. I want to be rich. Okay. And that's something that we need to remember. I don't care about being right and sticking to my guns. I don't care. I just care about making money. That's all I care about. Protecting my money and making more of it. Taking care of my family. Taking care of my damn self. Because I'm an independent woman. Let's go. So anyway, next target to downside probably going to be that $42 range. After that, we can start looking at some of these other key Fibonacci levels and clear like horizontal supports, etc. But as of now, it looks like we are finishing out, in my opinion. Actually, I will go to the long-term chart for this. It looks like, in my opinion, what's going on here is it looks like we have essentially a 5-wave structure that's completing. Going back to 2008, which is our bottom after the massive crash from 2000, which we never were able to take and put in a new all-time high from. So we have our 1-wave up, our 2-wave, our 3-wave, our 4-wave, our 5-wave. The difference between the 2 and the 3, it doesn't necessarily look like it on this chart right now, but if we actually take that difference and we move it down here to the 1, it is in fact higher in price action. So it is a valid potential target. But essentially coming up here to the 5, we have a potential top of 1, 2, 3 drives of bearish divergence, 1, 2, 3 drives of bearish divergence, 1, 2, 3 drives of bearish divergence. Looks to me like massive amount of distribution has been taking place basically since 2017. And if we break down below this level here in yellow, or potentially even just the 236, we likely see our next key fib level. So if we go back to the beginning of that push up from 2000 and basically like 2009 to the top right here, We see the 236 is that key level we've been holding in green. We see our next target to the downside is the 382 in green, and we see that lines up almost perfectly with 200 exponential and simple. So that is my initial target, and that is in the mid 30s. And that is where I think Intel goes. Now from there, does it bounce back up? Does it maybe get to the yellow here and then bounce back up and retest? Either one of those is a possibility. But I think eventually, depending on how long it takes, we get down there. Now, once they have a new foundry, once some of this stuff goes into effect in 22, 23, 24, 25, things might change as we bring back manufacturing to the United States. I think Intel having a foundry in the U.S. could change its long-term view, could change semiconductor space, etc. But in the meantime, it looks terrible. 821 across the downside, looks like we're coming back down way lower. So that is like the weakest of the semiconductors. Let's look at the strongest. So NVIDIA, let's look at NVIDIA. So NVIDIA obviously had our beautiful breakout up to like 350. I've been, screaming about how good NVIDIA is since way back before the stock split even happened, since way before that. And, this massive semiconductor bull run. Now here we are essentially in a descending broadening wedge or descending channel, whatever you want to call it, retesting the 200 exponential and simple. So what was the strongest is now looking weak. So when we see all these big, strong stocks that have been holding up all the key indexes looking weak, that tells us that the likelihood of the market continuing to look weak or selling off violently is very high. Hard sell signal on the daily. The last time we had that happen, pretty aggressive. We had the 821 cross the upside at resistance, getting rejected. NVIDIA does not look good. I think our next target to the downside, if we break down from here, is probably right back around $200 again. And then, at that point in time, we'll have basically wiped out since July 2021 gains. So maybe by the time we get there, a year worth of gains, and this is going to look like a massive blow off top. Now, granted, when we went into that bull run in August of 2019, we have reclaimed every time we came back down to 200 exponential and simple. That's been a buying opportunity, buy the dip opportunity. But now here we are potentially just consolidating at those levels. So we could arguably still buy the dip right here, but we have to understand that this is an inflection point where it may be time, if these flip over, if this slope levels back out and we break down below them, it may be time to be selling the rip. So, very close to confirming into a bear market. So very close. And this is one of the stronger ones. This is literally what's holding up the markets right now. Netflix. Okay, this was a request. In my opinion, Netflix still looks like total trash. Very clearly in a bear market. We broke down below here. We had a massive gap down. We tried to fill the gap. Couldn't even get close to it. We had a gap to the downside. We came back down and filled that. So do we go lower here or do we go higher here? Well, is Netflix doing anything differently? Because Netflix was literally just going sideways for a year. And then what happened? Squid Games pushed it up and it had a blow off top and then it capitulated. So now it's back down. Netflix right now is at 2018 June levels. So we're at support. We have a bunch of support right here that we had to try to break through. We finally broke through it and went much higher. And now here we are sitting on it. So if we sit on it long enough, maybe we get the reversion to the mean play and we come back up here and retest the 200 exponential and simple. But to me, that's a sell the rip opportunity. Now, could we scalp this back up? It's possible. But what if we just see it sell off again more violently and come back down to more support? Either one of those situations could happen. So to me right now, I don't see any strength coming out of this. If I'm going to buy the dip on this, I'm going to wait until the 821 cross back to the upside. I'm going to wait until this flips back over green. And then I'm still, if I'm scalping a buy the dip on a bearish asset, I'm selling the rip. So even if I'm going to buy the dip on the 821 cross, I'm going to sell it to 200 exponential and simple, assuming that it gets rejected and continues lower. But in my opinion, I don't see any opportunity right now. You could argue we have a horizontal support and you're going to buy that. And I wouldn't disagree with you. And that would 100% be a choice. And as long as you know what your invalidation points are and why you're taking that trade, that's fine. We're seeing a bunch of strength here on the histograms, but we're also getting a hard sell signal on the daily. Everything is trending to the downside. I don't see enough reason to enter Netflix here at this price, at this valuation. Obviously we just saw their earnings came in, it was a beat, and then they capitulated. So what happens if they miss? I mean, they still have some time, obviously, before they report again, but I don't know. I don't like it. And there's some fishy stuff going on with some of these companies' numbers and reporting, etc. So Apple. So Apple, obviously, one of the strongest stocks in, the U.S. stock market in the world. Absolutely crushing it. So what do we see here? Well, we're essentially just putting in lower highs, potentially coming down here to put in a lower low and retest 200 exponential and simple. So will I look for an opportunity on Apple at the 150 range? Well, if I'm going to buy the dip on something, I would rather buy the dip on something like Apple or NVIDIA that is strong and expect a bounce back up at least to the top of the range, but Where does that put us at? Well, it puts us where we're at right now. So if my high side target is 166, if we stay range bound, I'm looking to buy at 150. I'm looking to sell at 166 for like, a 10% scalp. And then if we break out to the upside, that's fine. Maybe I still have part of my position open, etc. But right now, does not look particularly great to me. Looks much, much better than anything else pretty much we've looked at so far. So if the strongest stocks don't look great to me, the strongest indexes don't look great to me, what do the weak ones look like? I mean, we're not even looking at them. They look terrible. Amazon. So Amazon has been range bound now since July of 2020. I mean, we're coming up on 2 years trading inside this range. And again, this looks like a massive distribution pattern. So we talked about this the other day and how when I looked at the risk reward, the reward to the upside was just back to the top of the range. The risk to the downside is just back to the bottom of the range. And then realistically, it's the measure move if we break down from here. And since then, this thing is already down. Now, I did not take this trade. I was using it as an example. It's already down 5.5% since then, in 2 trading sessions. So if we're right and this does break down and this does play out, then I'm going to start looking at a buying opportunity down here for something like that. But this to me just looks like the reversion of the mean. We enter into a bear market, we come back down, retest support, we come back up, retest our breakdown, our 200 exponential and simple moving averages, we sell the rip, exit our positions, and then we wait for this to go lower, or we potentially short off of that, or we use options, off of that, etc. But we do expect lower prices on this because we have now officially transitioned into a bear market. Now, previously when that's happened, it didn't last that long, and obviously Amazon's chart looks absolutely phenomenal. But do we want to risk the downside because we just don't feel like selling our position, or we're just complacent because Amazon only goes up? Not me. That's not my strategy. My strategy is consistent. I get out of the way when it looks bad, and then I get back in when it looks good. And when it looks really good, I continue adding to my positions. And when it looks really bad, I'll either add to my position to the downside, or I will, just keep doing what I'm doing and wait for the opportunity. So we saw a little fake out, 821 cross to the upside, reversion to the mean, rejection. That's it. We no longer want to be involved in Amazon at this time, in my opinion. Not financial advice. Google, again, strong for so long. Obviously love Google. We literally would not be here streaming today if it was not for Google. I definitely trust Google as a search engine. They definitely don't sell any of your information or spy on you or anything like that. YouTube definitely doesn't use tricky algorithms to, make their own decisions or political agendas or anything clear. They definitely don't censor or shadow ban people at all. And they definitely don't just let bots and, scam sites or whatever that pay them continue to operate. They definitely don't do those things. I obviously love Google and love YouTube. But the chart right now doesn't look great. Doesn't look great. We had a massive gap up. We bled out. Okay. That was off a good earnings call. So what does it look like? Well, we're threatening a bear market now. We're threatening the bear market on Google. We're below the 200 exponential. 200 exponential slope is flip red. 200 simple slope is still technically angled to the upside, but it's above the 200 exponential. It looks weak. Remember what we said. The cross happens to the upside. We often still put in a new high. And look, we did. We gapped up, put in a new high, and then we just bled out. And this looks like this is going to get real nasty if we break down from here. So, and these are the good stocks. So the last one that we're paying attention to is Microsoft. Microsoft looking like a massive head and shoulders, even more so now than when we discussed this the other day, a couple days ago. So we obviously have our left shoulder neckline, head, neckline, right shoulder potential. You guys know I like more symmetrical patterns than this. So I would not be surprised if this all ended up being the head. And then we came up and put in a right shoulder afterwards, and it looked a little more symmetrical. But at this point in time, we're back down below the 200 exponential. The 200 simple has crossed above the 200 exponential. So maybe we still bounce this and put in a new all-time high. And I'm wrong. It's definitely possible. But it looks very weak right here. It looks like it wants to break down. We already tagged the 236 of the macro of this entire bull market, basically going back to, the sell-off in March 2020, the CVD dump, all the way to the top. We came down, the neckline is a 236. We came up, we put in a series of lower highs. So a breakdown from here likely takes us down to the 382, which is 242 on Microsoft, possibly closer to the 0.5 in the measure move breakdown of the head and shoulders potential pattern, which is like 216. Now at those key levels at the 382, at the 0.5, again, I'm looking at this as a buying opportunity. But again, if I'm buying a dip on something that's confirming into a bear market like that, I'm buying it on strong stocks with earnings that have future that, I'm not buying it on speculative, don't make dollar, don't make sense stocks. So if you want to buy the dip, if I'm going to buy the dip, I should say, I'm going to buy the dip on strong stocks that have a legit future. I'm not going to buy it on companies that don't make earnings or don't make money or, I'm not buying the dip on cryptos. I'll put it that way. You know, and I love crypto. I have a channel called Crypto Gen Trader with tons of crypto content. I love crypto. I love, you know, the idea of blockchain technology, of cryptocurrencies, the future, the potential. But let's be real. Crypto looks like shit. So I'm going to take a quick drink. We're not going to take a break. We're going to keep on ripping, and we're going to look at some cryptos next, actually. So if you have any questions, any requests, anything like that for cryptos, please post them up in the chat, and we'll take a look. I'm going to wet my whistle, and then we'll keep on rolling, baby. All right, let's jump into the cryptos. Critty in the house, and we about to take a look. If you are just tuning in, make sure you like and subscribe. You guys know that the indicators are available for free down below, with the exception of the TD Master, which is the main one I'm using on the screen here. And then also the second one of the indicator oscillators is the Jewel Thief. I have previous iterations of that available for free. And then I reserve those two for group members who have shown their support. It is a one-time entry into the group. If you're interested, you can shoot me an email. And then obviously the final one down here at the bottom is the TJD TDMACD, which again is available for free. Highly recommend that you check them out, backtest them, give them a use, see what you think of them, whatever. If you are interested, if you're new and want to be a part of the group, you can reach out to me, obviously. We do stream 3 days a week on Wednesday evenings at 8 p.m. Eastern Standard Time. Fridays, this is our first Friday stream, but it will be every Friday at 11 a.m. Eastern Standard Time. And then, of course, Sundays for our market look ahead on 8 p.m. Eastern Standard Time on Sundays as well. So here's our Bitcoin chart. Again, we see that same signature happening. We're starting to lose moving averages. We have the 200 simple above the 200 exponential. We come up here, we put in a new all-time high, and then we break down. The futures chart has very clearly confirmed into a bear market. Here's our reversion to the mean play, our scalp play, and now here we are selling off, breaking down from key support. We have a high, we have a low, we have a lower high, now we have a lower low. So now here we're looking at the macro, and when we look at the spot chart, we can look at how we played that, how we took advantage of the measure move and everything. We do have a hard sell signal about to print. We have left the bullish control zone, obviously, and then obviously we have multiple red histograms in a row. We're still above the zero line, above the blue slope line, but the 821 are getting ready to cross down. Overall, it does not look good. It looks like we are very likely going to be retesting the bottom of the range, which in this case is 35.7 based on daily candle closes. And if we break down from that, we're probably going to test the bottom, which was like 30K, at which point in time this is going to look really, really bad. Really, really bad. And then if we just look at, we'll go to the Bitcoin spot chart. So here is our Bitstamp chart just for, longer period. So again, we see we have the peak high right here. We have a low. Then we have the higher high right here. We come back down. We have a higher low. So technically, still good for now. Put in a higher low. We come back up. Put in a higher high. Looks like we're still trending to the upside. But what we see here is the 200 simple is still blue, but the 200 exponential has flipped over red. We got rejected at this level. We had a very, very bearish candle come in here yesterday and specifically spoke about how if we broke down below, I mean, obviously we took profits on that scalp trade already, but we spoke about if we broke down below 42,000, we likely went to 40, and then 38. And then realistically, we start coming back down to like 35 or 30, etc. Same type of thing. Losing momentum, hard sell signal, a bunch of red histograms, 821 getting ready to cross to the downside. Fundamentally, technically, everything just looks like trash. And again, this is much stronger than most cryptos. Most cryptos look absolutely horrendous right now. If we switch out to our weekly chart, we can see we had a couple things happen here. So we called out triple bearish divergence on the top here on the daily, and then we were able to capitalize on the move down. Called out triple bullish divergence on the move back up, and we were able to capitalize on the move back up. And now here we're looking at on the macro, that was on the daily. We saw those things and identified them as well as this low right here. But now here on the daily, we have a high, then we have a higher high. I'm sorry, on the weekly, a high and a higher high on the weekly. And now here very clearly on our indicator oscillators, we have a very high high here and we have a very low high here. So we have bearish divergence between these points. We spent much less energy on this push up. This is the amount of energy we spent, the amount of rocket fuel we used to get to that high. And then here we use much less rocket fuel, but price went higher. And then again, on the Jewel Thief, we have a high through here and we have a lower high through here. So we use much less energy to get to higher prices. So what does that mean? It doesn't mean we have to just sell off immediately and go to zero and Bitcoin's dead. What it means is that it's unsustainable. We cannot continue going higher using less energy. we need to have our indicators and oscillators line up, or else we get a divergence. And that's what we're seeing, a bearish divergence taking place. Now it's possible, and I spoke about this on last stream, we have a low right here, and then we have a higher low here. If we find support right here and then continue back to the upside, it's possible we actually print bullish divergence. Because here we have a low, then here we have a lower low, but now it's flipping over red here, so it looks like we're going to go lower and continue down. So if price action is higher right here, but the indicator oscillator is lower, there's possibility if this rolled over and just started going up, that we would print bullish divergence the same way that we've already printed bearish divergence. Now, I think more likely what's going to happen is we're actually going to get rejected here and continue lower, take out this low, and then we'll just have a low and a low, and then we'll just have a lower low here in price and a lower low here on the indicator oscillator, and that will invalidate our bullish divergence. And we will likely retest the 200 exponential on the weekly, which is 25,800, or the 200 simple on the weekly, which is 20,000, which is also the previous all-time high from our 2017 bull market. And talking about like the 4-year cycle and all that stuff, you guys know how I do it. Now let's look at our monthly real quick, and then I'm going to switch back to a shorter time frame. We're going to talk about that. So here on the monthly as well, we see a high here on price action. We see a higher high here on price action. And then again, if we just look at our indicator oscillators, we see a high right here. And then this is technically our little peak, our pathetic peak. We can use the knife for this though. We have a high here. We have a much lower high here. We have the high here on the Stoch. We have a much lower high here on the Stoch. Compared to price action, we see bearish divergence, unsustainable. Here we have a high. Here we have a lower high in the TJD, TDMACD. And again, bearish divergence, unsustainable. So this is how markets top. This is how people get wrecked. This is how they lose all their money, talking about bags are packed, rocket ships, all this stuff, and then they lose everything, and then they go back to working at McDonald's. So don't be that pleb. So here we have basically our chart that we've been following for some time here. We had our descending. People have been drawing this as a wedge and all kinds of like fantasy patterns and stuff. Well, they're wrong. I mean, you can draw it however you want, but that's not what it is. It's very clearly a channel. We had a, spring or failed breakdown right here, and then we reclaimed that level, took a scalp trade to the upside, 821. We had the measure move. The measure move played out perfectly. If we turn off our drawing tools, we see the peak of the measure move. Although it fell short of the 200 exponential and simple, it perfectly tagged the 200 exponential right here on the futures chart. So the futures chart to me is much more reliable based on facts and statistics, and that's where the adults play, as opposed to like the cult members for crypto that don't use like, actual math or science or any reason. They just buy the dip, buy the dip, buy the dip, and just, sell the Ponzi scheme, buy the dip, sell the Ponzi scheme, buy the dip. So eventually, obviously we put in that measure move, which is this channel right here, and then tops out right where we're at. Done, rejection, rolling over. This is our reversion to the mean. After the reversion to the mean, we likely see lower prices. Does not have to happen. This could easily invalidate, find support, and continue back to the upside. And I will 100% be bullish back in it. But we're about to confirm the 821 cross back to the downside. The measure move already played out. So we don't wait to be proven wrong. In this case, if we're going to be bearish because we're below the 200 exponential and simple, and we're in a bear market confirmed on futures, technically not on spot right here, although we did confirm a bear market previously on spot a couple times here. But if we're just going to go by the futures chart and say technically we're bearish here, or we're at least neutral, we want to be selling the RIPS. So we sell once the measure move plays out. We sell once we get back to the 200 exponential and simple. And then if this consolidates and comes back up above that level, we will pay a higher price. We will pay the premium. We'll pay the insurance for being wrong. And then we can easily just continue moving to the upside. We can go to 100,000, $250,000, $1 trillion, whatever. But in the meantime, we are selling the RIP because this looks bearish. So that's what we're doing right now. That's what we're sticking to. And then if this flips back bullish again, we'll be buying dips. But in the meantime, we are selling RIPS. Ethereum, again, looks very, very bad right now. Very bad. If we turn on our drawing tools here, we see Ethereum was operating inside of a channel for literally the entire bull market from like $100. Had a throw over right here, came back inside the range, consolidating, found support at the bottom of the range, kept topping out at the heart line. And then here we see it topped out and rolled over. Obviously we have a parabolic resistance, 2 points right here in red, then 2 points right here in orange, and then we were watching these multiple points here in yellow, broke through that, we had the 821 cross, we had the measure move, we took the scalp play back up to the reversion of the mean play, and then again, we got rejected, and exactly what we said happened the other day. I said, I think we likely double top right here on this orange trend line. So this parabolic trend line acted as resistance if you didn't have this parabolic trend line, you're like, oh, what happened? We didn't even make it to 200 exponential. What the hell? Why are we topping out? No way we're putting in a lower higher. So that's why all these different techniques and strategies are so important, so effective, and so, efficient, is we use all these different things when they're relevant. I don't literally just do the same thing every time. I do the same thing, and then I look for what works. So we don't often use parabolic trend lines for bottoms and tops, but when we do, it's because they're relevant. So here we see the relevancy of this double top right here, and then we just continue in the downtrend. So likely we find some kind of support at this yellow resistance when we come back down to it, but we probably continue to just put in lower highs and continue to the downside. And then obviously we can look at things like a, macro Fibonacci from bottom to top or something like that. We could draw it either way, from the low right here or from the low right here, and it's not going to make much difference. Technically, we should do it from the actual swing low, but again, it's not going to make much difference. And we know obviously that our clear support down here, the 236, is what we have in green, and that's eventually our target to the downside. Or we can just use both and see which one works better once we get to it. So that is Ethereum. Let's look at Bitcoin dominance next. So obviously Bitcoin dominance chart, we're inside of this little channel. We have put in 1 drive, 2 drive, 3 drives of bullish divergence. Each time we put in a lower low, and then 1 drive, 2 drive, 3 drives on our indicator oscillator. Each time we put in a higher low, 3 drives of bullish divergence, likely pushes back up to the top of the range. We were talking about that before it happened, and now it's happened. And in the meantime, altcoins have gotten absolutely wrecked, and Bitcoin is just gaining value compared to them. We expect resistance at the top of the range once again, and then eventually we expect a potential break of that range and measure move to the upside, and that measure move break to the upside will probably take us up for our reversion to the mean play to retest the 200 exponential and simple, which will give us potentially our 1, and then the 2 would be a retracement back down here, alts gain compared to Bitcoin, and then potentially break out back to the upside, when a bunch of alts go away if we enter into a long bear market. Now, this is exactly what happened in our previous bear market. We entered into a bear market. This was when alts peaked in 2018. And then we have 1 drive up, 2 back down to a higher low, 3 drives up, 4 back down to the top of the 1 for once again a higher low. And then the 5 is a reversion to the mean playing out. At which point in time, we did something, which is what I suspect we're doing right now on actual Bitcoin price, which is obviously not many people have looked at this, but some people have started to repeat it now. But I think we're going into an expanded flat. Which is basically an ABC correction pattern. But in this pattern, the A correction actually comes down, and then the B comes up, and it actually puts in a higher high than the top of the 5, which is the only Elliott wave correction pattern that actually takes out the high of the 5. So that's what I think we're doing on Bitcoin. I think when we went up to 70,000, that was our B, and we actually put in a higher high than the top of the 5, which was at 64,000. And now I think we're preparing for, or entering into, we're probably like right around here in our C. So we basically have come back down on the B towards our C right here, or from the B towards our C right here. And we're basically just slightly higher still than that previous low. And then we're getting potentially rejected right here. And I think we roll over and go much lower. So that is a perfect example of when Bitcoin previously has put in a 5-wave Elliott wave correction, of a bear trend with a bullish correction. And then from that bullish correction, we actually had an ABC bearish correction inside of it, which is an expanded flat. So, and then we can break that down into 5 waves down or 3 waves down or 5 waves up or all, it's just basically just one inside of another, inside of another, inside of another. But that is what I'm looking at right now. That's what I'm expecting. Does it have to happen? No, we have plenty of time to figure it out. This is a weekly chart. But so far it's been playing out perfectly. So crypto total market cap, obviously same thing here. We put in the high, put in a slightly higher high. We hit the 1.618 of the previous high right here, which is how we were able to identify that as the exact top. So if we draw Fibonacci from the top here at 20,000 to the bottom here at 3,000, the 1.618 Fibonacci top was exactly at our red box right here, which is exactly where we topped. We see also 2 drives, one high here, one higher high right here. And when we line that up with our indicator oscillators, we have a high and a lower high. We have here as well a high and a lower high. So we see bearish divergence on the weekly taking place on the crypto market cap as well. We see the 821 have crossed the downside. Previous time we saved it. This time looks worse. Looks like we're getting rejected and continuing back down to the downside. So next target to downside would be support around obviously our previous low right here at 1.65 trillion. Then after that, our low at 1.27 trillion. And then after that, our low at 986 billion or 1 trillion. Please keep in mind, I do not hate crypto. I'm not mean, and I'm not fudding your crypto coins. Okay, I love crypto. I've been involved in crypto longer than 95% of the people that will probably watch this video, maybe more than that. But I'm using technical analysis and real life and what's likely to happen. Okay, I'm not just being mean to your precious cryptos. And I know most of you guys know that, but there are definitely some new people here. I don't want people to just think I hate crypto. But if you look at the analysis, I don't hate stocks. I don't hate crypto. I don't hate investments. I literally have a channel on the internet where I teach people how to do technical analysis in a group where we literally just make money trading. So I'm just a realist. I'm just using actual technicals. Okay. Do I think crypto does well into the future? Do I think we have another bull market after this one where we go much higher? Yes. But in the meantime, could we? Do we? Will we? Maybe. Do we have a bear market where most cryptos go to zero or lose 90% of their value, or Bitcoin loses 75% of its value, and it lasts for a year and people forget about it and give up on it and quit and the metaverse dies and all this stuff? There's definitely a very high possibility that that happens, okay? And my job is to protect my money, my principal, my capital, and make intelligent decisions. And that's what I'm doing here. I'm not just being mean to crypto or stocks or whatever your favorite stock is, whatever it is. So just to clarify that, I know most of you guys know that, but you know, sometimes people get sensitive because they're overinvested or they really, you know, they're buying what people are selling. So Solana is next. Solana, obviously I do requests as well. You know, group members obviously get priority, but anybody that wants to put a request, I'm glad to take a look at it. All right, so Solana, we were operating inside of, it's been a while since I've actually done technical analysis on this chart here. Let me just extend out these resistance and support lines slightly. So it looked like we were breaking down from this level. We reclaimed it. We came back up to like the heart line. We failed to cross the 821 back to the upside. So we basically have just been selling off inside of this range for a while. We're now well below the 200 exponential, which has a negative slope, and we are actually below the 200 simple here as well. It does still have a positive slope, but it's basically flat right now. So Solana looks bad, and it's basically at the previous lows. So where Bitcoin is still above the low from like its cycle top, we're at the lows right now. So if we break down from here, Solana likely goes much, much lower. This may not be the best chart to do Solana on. I don't even know what I have. Kraken. But we can just kind of look at it and see, okay, we're getting pretty good interactions. So I like this chart. We have very clear, you know, resistance at the 786 here. We have some clear, you know, consolidation points at like the 0.5 here, clear areas here at the 236. And then obviously we top out, find support at the 236, support and resistance at the 236, support and resistance to the 382. So our next target likely to the downside is the 0.5, and Solana probably goes down to like $73. So that would be our next target to the downside, somewhere around there. And then after that, the 618 and likely like $54. So that's what we're paying attention to. I'm not trying to FUD anyone's precious Solanas. I know that the Solana cult is strong. Let's be real though. Solana's had some serious problems lately. You know, I mean, you could say that about Coinbase. You could say that about Solana. You could say that about my wormhole. They got inside my wormhole without my permissions, and they stole all my cryptos. And I was trying to bridge the gap, and I got penetrated, and they flooded my wormhole and took my millions. But everything's okay now because it's just growing pains. They penetrated my wormhole with the growing pains. I'd be real careful with some of these cryptos and DeFi and whatnot. So, but that is Solana for now. Does not look good. Matic. So Matic has been staying strong for quite a while now. And as of now, all right, Compact, how about no, dude? I'm going to remove your comment, but you're not going to post shills for like random stuff I've never even heard of. I mean, you can't post shills for stuff I have heard of, but definitely not things I've never heard of. Get out of here with that trash, okay? Especially I mean, we're very clearly in a bear market, and you're like shilling garbage trash coins. Yeah, okay. How about no, dude? If I was going to shill stuff on my channel, I would have took the one of like 1,000 bribes in my email box, not just let you come and do it free on the live stream. So, no. Matic. So Matic's been operating inside this channel forever. We have had quite a few successful trades on Matic, and then finally the last one here did get stopped out. We broke down from this level. Came down, found some support at the 200 exponential and simple, but we are losing support. They are rolling over. This is looking the worst it has looked for a while. So, we have been very bullish on Matic for a very long time and done very, very well trading Matic, not just buying and holding, but like scalping it along the way. And the truth is, man, Matic it looks rough now. I mean, pretty much all crypto looks rough now. We have the breakdown, which didn't happen back here. So depending how we want to do this measure move and where we want to do it from, we basically had that play out. Obviously, we had our initial support off of the 200s, and that had like a little bounce. But to tell you the truth, this looks rough right now. I mean, we're technically still in an internal retracement from the high to the low right here. But if we just flipped it and just did a fib the other way, it's going to look the same. The numbers are basically just opposite because it's basically just a range because we came back up and basically just double topped. So the bullish fib looks exactly like the bearish fib. The numbers are just flipped. I mean, almost, not exactly. But you see the 236 and 786 are like in the same spot. 618 and 382, the 0.5s, the 382 and 618. So either one works. You can kind of use it as both. We see clear resistance and support based on both of them. So at this point in time, we already came down and retested the 0.5 from the all-time high. So assuming we are getting rejected at the 786 or the 236, the next target is going to be a retest of the 0.5. So $1.36. But realistically, we probably go down to the 382 or 618. We probably go to $1.12. Excuse me if I just burped in the microphone. Sorry about that. And if not, and you wanted me to burp in the microphone, sorry guys, missed your shot. So yeah, that's it. That's our target. That's where I expect us to go, somewhere around there. Keep in mind, this is the Kraken chart, so this gets a little wicky at times because of liquidity. Some other exchanges probably have more history or less wickiness. But yeah, that's our target, $1.12, which right now we're at $1.60, so that is quite a drop. That's like 33%. 30 plus percent probably from here. Now we are technically still hanging on to support for now. And we probably do take a pit stop at $1.35, but we have a high, we have a low, we have a lower high. So we probably are just going to put in another lower low. This is just not the time to be speculating on a lot of these cryptos, in my opinion. And again, it's all about de-risking for me. We can get back into these later on at probably much lower prices, maybe slightly higher prices. But the risk we're eliminating is exponentially more valuable to us than the rewards we would potentially miss. If this starts breaking back out to the upside, we can put some targets in play. We can look at key levels we would retest, and potential targets to the upside. But right now, we're not seeing any of that. We failed the 821 cross or couldn't hold it, and we're losing the 200 exponential and simple for the first time in this thing's existence, at least this chart's existence. So, we're basically confirming into a bear market on, I might have said Solana, but Matic. AVAX, Avalanche, again, by request. We don't have a ton of history on this. I don't even know what the chart looks like. All right, so we obviously had a bunch of nice plays already play out. Been out of this for a while, guys. Something like this probably for resistance is what we're looking at, a series of lower highs. We are still in an internal retracement technically from the high to the low. So let's extend this out and see what we're looking at here. So basically we came all the way back down to the 886. I'm sure I know this thing went absolutely parabolic before it got listed on like any big exchanges. But it's respecting this stuff pretty clearly. We're respecting the 382, the 236, respecting the 0.5. Like this is trading very, very technically on this internal retracement. So I think that's the way to look at it. So if we're topping out now with the 386 and we previously came down to the 886, the next support is going to be the 618 at $76 again. After that, it's a 786 at $64 again. But realistically, this thing probably comes back down to the 886. I mean, it looks terrible. It looks absolutely terrible. I mean, we have like some kind of like channel / descending broadening wedge thing going on, but it looks terrible. We're basically at the top of the range now. So the likelihood of us going much lower from here is higher than us going much higher from here. So, if we're going to say if we take out this high and break out of the range, we're bullish, that's 18% from where we're at right now. But the target to downside is 39%. So it's a 2-to-1 risk reward ratio to the downside. Now, I'm not saying I want to short this right this second, or that I'm going to short this at all. But what I'm saying is that the risk is much higher than the reward right now. So if there was a trade here, it's to the downside, in my opinion. And then obviously we take out the upside target, previous high right here, break out of this range, we can get bullish on it. But right now, it doesn't look good. We do have a little momentum, but we're getting the hard sell signal. Barely hanging on to 821 for right now. Avalanche looks bad. I think that was it for the crypto requests, actually. So I have also DraftKings on here, AMC, and GME, Game Stonk. So we'll look at those as well. So DraftKings looks absolutely terrible, still absolutely horrible. Just getting absolutely decimated at that previous support we discussed. We got a dead cat bounce, couldn't cross the 821 back to the upside. Now remember the strategy we talked about in the very beginning of the stream. If we confirm this 821 cross to the downside, while we're technically bearish on this, we would have taken a position in here for a scalp potential move back up, the reversion to the mean play, and then taking profits at the 200 exponential and simple, which would have, could have, should have been a nice trade of like 70 to 80%. But because that failed and rolled over, and the fact that it failed literally perfectly tells us, wait a minute, we must be doing something right. We must be using the perfect settings, because we could have easily gotten a false signal here. And sometimes we do get a false signal, but we didn't. We got the exact rejection perfectly, and then we got a gap down on positive earnings to a new low. So this to me looks terrible. This looks absolutely terrible. I mean, I do this all the time, and I know we do have a lot of people here, but let's just say you invested in DraftKings anytime, since February of 2020, with the exception of this little drawdown right here if you bought the dip. Other than that, you're negative. DraftKings has only just gotten destroyed. It's wiped out everyone that put any money into this in the last, year. And massive, massive gains were wiped out. Because now it's at $17 and it went as high as $75. So there's literally people right now that got stopped out at the top or bought the top or whatever that are down 76% on this thing. So there's so much pressure, so much headwinds for DraftKings to ever go back up that I'm not trying to pick bottoms on something like this. And if I was going to pick the bottom, I would try to pick it at like, $10, not at $17. Because we could eat, people are like, yeah, but it's already down 76%. So it's a great buying opportunity because it's already down so much. Well, the next support level is down another 38%. So there's a 40% downside just to our next support level. That's absolutely horrendous. I don't want to give up 40%. If I was going to give up 40%, I would just bet on Kathy Wood. Sorry, I know she was like crying on CNBC, so I should probably lay off of Kathy lately. But I'm not taking the song down, okay? You'll never get my song. You might get my pity, Kathy, but you'll never get my song. So very much respecting these key levels. Look at how many times we've interacted perfectly with these levels, not only on the way up, but on the way down as well. So these levels were already playing, key levels before we even had them on the chart, before we even peaked out. So the fact that we're still respecting them on the way down as resistance, support, very key. So I think the 786 is probably the next level I'm looking at, $15. After that, it's the 886, maybe $12.50. And then, eventually just back down to $10 again. But I mean, this thing, to tell you the truth, I mean, DraftKings probably goes to $10. I mean, anything could change between now and then, but it probably goes to $10. Let's be real. It probably goes lower than $10. AMC, very clearly in a bear market based on the 200 exponential. 200 simple is all but flat at this point in time. So it's still technically in a bull market until the slope flips, but it looks terrible. And now you see here, we had the 821 cross for a day, and then it got rejected. So we know that this had an attempt to try to move to the upside, try to have that reversion to the mean play. Got rejected. We're bearish on this. It probably goes much lower. And this is a pathetic attempt at the reversion to the mean. So we had a slight one right here and then went much lower. So we're getting a rejection right now. We probably put in a new low now. So we have a high, a low, a lower high, and then we have a lower low, a lower high, a lower low, a lower high. So what's next? Say it with me now. Lower low. It's probably going to go much, much lower. I mean, AMC is dead. I mean, I could have told you that a long time ago, but now based on technicals, AMC is dead. And it has been for some time. I mean, looks absolutely terrible. Tried to reclaim the 382 and failed, so it probably comes down to the 0.5 next. AMC target to downside, $11.86. Next target after that, $7.76. I fully expect this to accelerate to the downside. It looks absolutely terrible. But you can buy popcorn with Doge, so that's good. GME, GameStop, again, very much in a bear market. Confirmed to the downside, absolutely pathetic. Had an 821 crossback to the upside, looks terrible. I don't think this holds right here. It's trying to build up momentum. It's in the bullish control zone, but it's rolling over. I think this goes much, much lower. I think it goes much, much lower. Again, don't buy a company because you're nostalgic and you were on some pump and dump website that told you it was good. If you're going to invest in it, buy it for fundamentals. If you're going to trade it, buy it for technicals. But don't buy it because you're hoping and dreaming. That's not how you make money. Buy the lottery if you're going to hope and dream to win. GameStop looks terrible. It looks like a rejection off the 236. It looks like it goes down to the 382. GameStop at $65. That's a 50% haircut from where we're at right now. And that's just our next target. I mean, it probably goes much lower than that. So it probably loses 50%. And then after that, it probably loses another 50%. Because it looks like it's going back down at least to the 0.5. So $35 GameStop. If you came back to me in 6 months and said, "Crypto trend trader, I'm back from the future and it looks grim. GameStop lost 50% and then another 50%. Do you believe me?" I'd be like, "You're from the future and GameStop's down 50% and then another 50% and it's currently trading at $35? I mean, some of that seems far-fetched, but I do believe you on GameStop, at least. Maybe not time travel, but as far as GameStop, not going to be surprised at all. So I see nothing bullish about this. Nothing good long-term for fundamental investment or anything. If you're down on this now, what would I do if I was down on GameStop right now or I was up on GameStop right now? I would cut my losses. I would sell the RIP. This was our RIP right here. Maybe it goes to 150 and you're like, "Oh, I could have had another 20% of my money back or 20% more money," but it's in a bear market. It looks terrible. It's garbage. The fundamentals are garbage. The company's garbage. I mean, they were ripping people off in the 90s. You buy a brand new game for $60. You play it overnight. You beat it. You're like, "This game sucks. I'm trading it back in." They're like, "We'll give you $9. I could tell you right now that's a shitty business. I mean, good for them, but for longevity, come on, guys. So that's it for our cryptos. Let me see what's going on in chat. And then we're going to jump into gold and some commodities. And then we're going to wrap it up. What are we at right now? Been going strong and long. 2 hours and 16 minutes. Friday at 1:18 p.m. What's up, Peter? Good to see you. I have a friend who keeps bugging me to invest in Hex. What are your opinions of this crypto? I mean, it's essentially like a synthetic bond, the idea behind it or whatever. I think Richard Hart is a smart man. He's been involved in the crypto space for a long time, and it has made him very rich. So that being said, he's also kind of sketchy, and we're going into a bear market. So, I mean, I don't know what's going to happen with Hex. Maybe it keeps making money throughout the bear market. But I'll tell you right now, I don't want to be staked in something for long periods of time. It's the exact same argument as the bonds that I was saying earlier. I don't want a promise of coupons or interest if my asset that I have to lock up goes down substantially. And maybe you don't lock it up, maybe you just buy it or whatever. But, we're going into a bear market. Every crypto is extremely, extremely correlated to Bitcoin, and everything looks like it's going down in value. So, no, I don't want to invest in things that are going to be worth less money in the future that'll pay me interest. Think about how many people stake their Cardano at $2 or $3, and now Cardano's worth $1. So, yeah, sure, you made 12% annually for staking your Cardano. But the $100 you put into Cardano is now, at $3 it was worth $100, and now at $1 it's worth 33 cents. So you lost 66% of your principal, but you gained 10% or 12% or whatever on interest. That's how I look at bonds right now. Sure, you're going to promise me a yield that's okay, but at the cost of my principal? No, thank you. No, thank you. I mean, I would be careful. I wouldn't invest in anything right now, especially not in the crypto space. I might trade or scalp a couple things, but I definitely would not invest in anything crypto right now, actual cryptos. Maybe a crypto company, but I would even have to see that. I would have to see the technicals and the fundamentals on it, because chances are it's probably way overvalued and gets a serious haircut. Craig Mann says, got to run. Great stream. Thanks. Yeah, good to see you, brother. Appreciate you. Thank you for the kind words as well. So let's look at our commodities, and then we're going to wrap it up there because we're already a little over 2 hours. Try to keep these between around 2 hours. So gold. So we obviously had our breakout of the descending resistance line here in pink, purple, whatever. So we obviously broke out of that. We're on our way back up here to retest the previous high right here, which is a 618. I do expect resistance at that 618, but the more levels we step up, the more stairs we climb, the juicier this looks. So I'm still very, very skeptical that gold does top out right around the 618, at least temporarily. But if it holds here long enough, and you guys know I'm a long-term investor or hodler of gold or whatever. It's my insurance basically against the system. And great store of value. If inflation gets out of control, gold probably does very well. If deflation kicks in and goes out of control, gold probably does pretty well. And regardless, either way, I don't ever have to sell my gold. I can give it to my kids, one day, and it will probably have held its value the same way it did for the last couple thousand years. So, but it's 100% not a speculative investment the same way stocks and cryptos and stuff are in my portfolio. But it does look like it's likely headed back up to new all-time highs. If it takes out the 618, I will be pretty bullish. If it takes out the 786, I will be very bullish. So next key levels to watch for me are 1910 and 1980. But does look very good right now. Silver, not as much. Silver is trying to reclaim the 200 exponential as we speak. Headed back up to try to retest the 200 simple. The last few times it got rejected and is still very much in a bear market trying to reclaim these levels. And it looks like a giant descending triangle right now. So as of now, it's starting to build some strength and look better. If we start closing back above like 24.30, and then, definitely if we close back above like 25.30, it's going to start looking pretty juicy. And we probably head back up to like $27 to $30, maybe break out, maybe head to 50. But that is all still a long way away. And I think, honestly, monetary metal is going to do better than commodity metals are, because if the economy starts slowing, commodities are going to be less useful because we're not going to need them as much for production, because we need less stuff being produced because the economy is slowing. As we're with monetary metals, if there's uncertainty, whether it's war or stocks or inflation or deflation or whatever, monetary metal is going to hold its value better. And silver, even if it's considered to be partially a monetary metal, it is definitely considered to be a commodity as well. So I would much rather be investing in gold right now. Also, our gold-silver chart tells us that we are likely going to continue to the upside with our gold-silver ratio, telling us right now it takes 80 silvers to buy 1 gold, and likely in the future it's going to take 90 or 95 or 100 silvers to buy 1 gold. So if I was going to take right now, $2,000, and I was going to put it in either gold and buy an ounce of gold, or silver and buy, whatever it works out to, ounces of silver, 80 ounces roughly of silver, which one would I want? Well, if I buy 80 ounces of silver right now instead of 1 ounce of gold, and then soon it takes 90 ounces of silver to buy 1 ounce of gold, I lost money with that investment. I should have just bought gold. So if I think this is going to break to the upside, I would rather be investing in gold right now. If it gets rejected and starts breaking to the downside, then is when I want to start buying silver again. So right now, this looks like we're reclaiming a bull market after a bear market that lasted since July of 2020. So if we reclaim this bull market, like it looks like we're doing with the 200 exponential and simple flipping back to the upside and consolidating at resistance, which likely leads to a breakthrough and move to the upside, I want to be buying gold right now, not silver. Silver juniors, still very much operating inside of this descending channel, still getting rejected at 200 exponential and simple. Looks worse than silver actual spot, as it is consistently putting in lower lows, but would probably outperform if silver does well. I would much rather be investing in GDXJ if I had to pick one or the other, because it is at the top of the descending channel. And again, gold looks better than silver to me right now. So if this does break out to the upside, GDXJ probably going to be retesting some of these key levels, probably going to be at least back up here at like $55. It's at 42 right now. But again, I'm waiting for gold to break out, because how many times did we get faked out on this? And it's just been getting wrecked. All the people that have been investing in these miners while gold went sideways are wrecked. They're down 50%, and gold is still right where it was. It's down 5%. So, aim small, miss small. COPX, just a copper miner ETF, consolidating inside of an ascending channel right here. Still looks good, taking out the previous high, consolidating, probably heads back up to the top of the range sometime in the near future. This is kind of contrary. This looks toppy to me. It looks like we have bearish divergence clearly printing at these highs right here on the daily. So it looks like it's headed back to the downside, probably for at least a temporary double top here, based on these last few weeks of price action. So honestly, it probably looks good at about 37 bucks. And the same argument for silver and copper, definitely, commodity-wise. CCJ, so Cameco, just for our, taking a look at our uranium proxy, essentially. So we obviously had our ascending wedge right here, broke down, got the measure move, played out perfectly, and now we have a high, a lower high, a lower high, we have a low, we have a lower low. So we're just operating inside of basically, just a descending pattern. So as long as we're in a downtrend, as long as we're in a downtrend, which we clearly are, I would expect us to continue inside of that downtrend until we don't. And you're like, well, yeah, of course we're going to go down until we don't go down anymore. Sure, that's as simple as it is. We don't have to make it any more complicated than that. When we're no longer going down, we'll get bullish on it. But as long as we're going down, we will be bearish on it. So, but again, threatening the bull market here after months and months and months of upside. I'm still very, very bullish on uranium. But as far as nuclear power right now, as far as uranium right now, it is probably overpriced or due for a pullback at least. So it looks like it's going to come back down here. I expect this fully Cameco CCJ at $17 in the very near future. Looks weak. Long term looks great though. THCX, so here's our pot stock proxy. So we were talking about this potential 821 cross back to the upside in the reversion of the mean play. I've been slowly building a position in pot stocks because in my opinion they are very undervalued. Same with miners, slowly building a position because what do I keep reiterating over and over again? We're getting plenty of drives of bullish divergence, but these are getting absolutely wrecked. They're the weakest things in like all markets right now. They haven't put in new highs since their 2018 like Canadian legalization, like pot stock tops and everything. And on top of that, they just look terrible. They look terrible. So, we want to slowly build a position. I'm bullish on these long term, but right now I keep saying it over and over again. I would not be surprised to see us put in a new low. And it looks like that's what we want to do. So let's wait for this 821 cross, re-enter a position accordingly, or continue to build our position patiently, depending on if we're talking about scalps or actual like investments, etc. So THCX and pot stocks, and then lumber. I don't know if you wanted me to look at this again, but basically just a bunch of limit downs, a bunch of limit ups, a lower high. It's holding for now, but got to be careful. It looks like it wants to roll over for now. So we'll just see when it comes back down here. Does it put in a higher low? That's what we're paying attention to. So is this going to start developing into a downtrend after reclaiming 200 exponential and simple and just a macro downtrend since our like blow off top right here? I mean, we basically just have a big triangle forming. We just have a giant triangle right now, which is technically a bullish pattern, but we really just got to wait and see. So as long as we're just operating inside this range, we probably top out at the red line. We probably bottom out at the blue line. So as far as I'm concerned right now, looks like we come back down to the blue line and retest the 200 exponential and simple. So we probably end up down here at about 920. But this is fully like just speculation to me. I don't think this is lumber related at all. I think this is futures and betting related. But yeah, that's it. We did it. We did it. We made it through all the assets. We did our first Friday stream. Hope everybody enjoyed the show. Yay. Remember, this is not financial advice. I'm not your financial advisor. These markets are extremely volatile. Please do your own research and trade responsibly. If you're watching this live or you're watching it back later on, let me know what you think of the Friday morning / almost noon streams. Do you like the time? Does it work better for you in your country or for your schedule, whatever? This is going to be our new stream time. If you like the stream today and you're new to the channel, make sure to like and subscribe. If you have been following for some time and you're like, hey, this really works and I want to support this guy and all the hard work he puts in and everything, I really appreciate it. Feel free to join the group. It is a paid group. It is a one-time payment. It is pretty damn cheap for what you get and what you provide to the community, as that is what lets me stream now 3 times live every week on Fridays at 11 a.m. Eastern Standard Time, on Sundays at 8 p.m. Eastern Standard Time, and on Wednesdays at 8 p.m. Eastern Standard Time. And that is a one-time contribution, and you get the access to the TJD Master, the indicator I've been using throughout the stream. You also get the access to the TJD Jewel Thief updated version I've been using throughout the stream. And then regardless of whether or not you want to support the channel or, you know, financially not in a position to or whatever, that's perfectly fine as well. There is like 15 other indicators for absolutely free that you can find down below. Go over to TradingView, check them out. Some of them are older versions of some of the indicators. Some of them are the TJD TDMACD that we're using in stream. There's all kinds of different ones. There are playlists on how to use those various indicators. Some are old and poor quality. Some are new and good quality. And you know, tons of education on this channel. Like I always say, number one investment you should be making is investing in yourself in the form of education, in the form of knowledge, you know, learning, and then in the future you will be self-sufficient. Learn how to do this stuff, learn how to invest. You know, if it saves you from one big drawdown, it pays off exponentially. If it makes you some money in the future, it pays off exponentially. If one day you can retire and feel confident about your investments in various markets, whether it's crypto, whether it's stocks, whether it's bonds, whatever it is, and you recognize trends and you can know, hey, maybe I should be de-risking around here or whatever, that will exponentially serve you throughout your life, you know, over just having to turn in and look at what Jim Cramer's saying or some other YouTuber or whatever. So invest in yourself, protect your principal, grow your capital, you know, make intelligent trades, trade with the trend, you know, learn position sizing, learn risk management, learn risk reward ratio, learn, you know, what's your edge, figure it out, quantify it, create a trading plan, log your trades, figure out what works, what doesn't work, you know, etc. Educate yourself, and you will, if you spend time and money, whatever it takes, educating yourself now, future you will be forever grateful for what you do now. So you put in the work now, you reap the rewards forever. So if you have another 10 years in the markets or 20 years or 30 years or 50 years in the markets, you will be exponentially better off for taking the time to learn and educate yourself and not just saying, I believe in crypto, I'm bullish, oil's going to zero because clean energy, like F all that. You know, it's good to have fundamentals, it's good to look at earnings, it's good to do all that, but look, the technicals work. We prove it every stream, every video live. So there you have it. That's it for today for our Friday live stream. Everybody have a great weekend. Going to jump over in chat real quick and then say our goodbyes. Ralph Smith says, great content. Like the time. Excellent. Thank you, Ralph. I appreciate that, and I'm glad you enjoyed it. Tim Winkler, my man, says, great stream. Thanks a lot. One of the first times that I was able to watch you live. Watch you love. Bro, you better not be watching me love. Is that live feed still on? Can you see that? Did I leave my camera on or something? The timing on Friday is really good for me. Awesome. Excellent, Tim. Thank you very much, brother. So yeah, I appreciate everybody for tuning in today. Hopefully you enjoyed the stream. If you're watching this later on, make sure to leave a comment. Let me know if you enjoyed the stream time, but this is our standard from here on out. So make sure you tune in every Friday for our market wrap up. And, you know, obviously if you're interested in the trading group or the indicators, make sure to hit me up. Peter Gerd says, a great stream. Thank you, my brother. I appreciate that. To all the new viewers, likers, subscribers, all that good stuff. Appreciate you all. Tim Winkler says live. Haha. Yeah, I hope so, bro. I hope so. I hope you weren't watching me love live. I mean, that's a whole different channel. And it's not on YouTube. That's called OnlyFans. But yeah, hopefully you guys had fun today. You know, and enjoyed the stream. I always appreciate all the positivity, man. Love my community. You guys are all the best. And I know somewhere out there, there's probably one girl listening. You know, I appreciate the girl as well. But, you know, obviously predominantly, you know, is men. We're men in tights. But that's it for today. Everybody have a good one. Enjoy your weekend. I will see your group members out there. I will obviously post up all this stuff later on. If you guys have any questions, asset requests, anything like that, you can always leave them in the comments. I don't always see the comments on the videos. It's better if you can tune in live. But if you can't tune in live, message me in advance, and I am glad to look at any asset or talk about any particular micro, macro, you know, investing or, you know, world economic topic, anything like that, as long as the YouTube gods and algos will allow me to. Yeah, that's it, though. Appreciate you guys. Everybody have a good one. Glad so many people were able to tune in for the first Friday live stream. And, of course, we're going to make this a trend. So make sure you tune in on Fridays at 11 a.m. Eastern Standard Time, Sundays at 8 p.m. Eastern Standard Time, and, of course, Wednesdays for our midweek market update at 8 p.m. Eastern Standard Time. Remember, the market is closed on Monday, but I'll see you guys all on Sunday. I'll see the group members in the meantime. And that's it for today. Crypto Trend Trader with our Friday afternoon market wrap-up. It is 1:35 p.m. Eastern Standard Time on February 18th, 2022. And I'm out of here.